To order, and welcome back to the session starting in 2017 into the new year. This afternoon we're starting the study pursuant to Standing Order 1082, which is the study of the Canadian real estate market and home ownership, really related to housing prices increasing in certain areas across the country. So first off, we have three witnesses, and we'll start with the Bank of Canada, Sylvain Leduc, Deputy Governor, Don Coletti, who's an advisor to the Governor. The floor is yours, Sylvain.
Right.
Welcome.
Monsieur le Président, distingués membres du comité.
Mr. Chair and distinguished members of this committee, thank you for inviting me to appear before this committee. My colleague Don Coletti, who is an advisor to the Governor, is joining with me today. We are pleased to be able to contribute to your timely study on the Canadian real estate market. The Bank of Canada has a mandate to keep inflation low, stable, and predictable. Given the importance of a well-functioning financial system in achieving our inflation goal, we provide our assessment of the stability of the Canadian financial system twice a year through our Financial System Review. Let me focus on remarks on financial stability. Our assessment starts by identifying the financial system's most significant vulnerabilities. This is important, since financial vulnerabilities can help propagate and amplify shocks to the economy, which can lead, among other things, to larger deviations of inflation from our 2% target. Over the past few years, we've highlighted two key vulnerabilities that are relevant to your study: high levels of household indebtedness and house market imbalances. These two vulnerabilities clearly interact with one another as households borrow more to buy more expensive homes. Let me now briefly discuss these two vulnerabilities in turn. The first one, then, indebtedness, is well known to all. The ratio of debt to disposable income in Canada is now approaching 170%. It has been rising steadily since the early 200s. Additionally, the aggregate number masks worrisome patterns regarding how this debt is distributed. For example, our analysis shows that debt has become more concentrated over time in households with higher levels of indebtedness. Compared with their less indebted counterparts, these households tend to be younger and have lower incomes.
House prices, which now stand at a record of almost 6 times the average household income on a national basis. What's more concerning here are the imbalances in some cities, most notably Toronto and Vancouver. The price increases we've seen in those cities have been caused by a number of factors, ranging from demographics to low interest rates to constraints on land use. We've also highlighted our concern that expectations of future price growth may be a contributing factor. Because these expectations can change rapidly, the imbalances that have emerged make it more likely that shocks to the economy could cause a drop in prices. In light of these vulnerabilities, the most important risk to the financial system remains a large and persistent rise in the unemployment rate across the country, which creates both financial stress for many highly indebted households and a correction in house prices. In this scenario, households significantly cut back their consumption spending, while a rise in defaults and a decline in collateral values exert stress on lenders and mortgage insurers. Although we see a low probability of this risk materializing, its impact would be substantial if it were to occur. This is why we judge this risk to be elevated. That said, I hasten to add that we've concluded model simulations to analyze the effects of such a shock and found that the buffers in the Canadian financial system would be sufficient to absorb its impact. So while there would be stress, the financial system would remain resilient. Comme vous le savez, le gouvernement fédéral a...
As you know, the federal government made important changes to housing finance rules last fall. These changes should reduce the rise in highly indebted households over time by ensuring that borrowers are more resilient to potential future headwinds. We are not expecting the regulatory measures to lessen this vulnerability overnight, because it will take time for the number of highly indebted households to significantly decline. It is also worth emphasizing that under the new mortgage finance rules, the ability of all insured borrowers to make debt service payments must now be assessed using an interest rate that is higher than the prevailing market rate. As well, applicants must show that they can cover the costs associated with servicing not only their mortgage, but also their total consumer debt. We expect this more stringent test will reduce vulnerabilities not only in Toronto and Vancouver, but also in cities where house prices aren't as high relative to incomes, such as Montreal, Halifax, and right here in Ottawa-Gatineau. The last point I'll make is that the Bank of Canada can best contribute to long-term financial stability by keeping inflation low, stable, and predictable. To achieve our inflation mandate, we cut interest rates after the financial crisis and have done so twice since 2014 again after oil prices collapsed. Our actions supported income growth and the economic recovery that we have seen, helping mitigate households' financial stress along the way. This policy, coupled with other macroprudential tools aimed directly at financial vulnerabilities, is helping to preserve the stability of our financial system. Thank you. We will be happy to answer your questions.
Turning to the Canada Mortgage and Housing Corporation, Michelle Tremblay, Senior Vice President, Policy Research and Public Affairs, and Michelle Lawrence, Vice President, Housing Market and Indicators. Welcome. The floor is yours.
Thank you, Mr. Chair. It's a pleasure to be here. As you know, our President and CEO, Evan Sadal, was scheduled to meet with the committee today. Unfortunately, Mr. Sadal cannot be here, but he asked that I deliver these remarks on his behalf. Nous sommes heureux d'avoir cette occasion de contribuer à l'examen.
We welcome this opportunity to contribute to the committee's study of issues surrounding the residential real estate market and home ownership. As Canada's authority on housing, the CMHC continuously monitors housing markets and undertakes research and analysis to support informed policy and decision-making. This is key to fulfilling our legislative mandate to facilitate access to housing and contribute to the stability of Canada's financial system.
Exercise undertaken last year by our housing market analysis team confirms that the most important factors accounting for house price increases over the long term are economic in nature. Rising disposable incomes, increased inflows of people, and lower mortgage rates. 3 additional factors are contributing to the shorter-term price dynamics that are currently being felt in certain urban centres, notably Toronto and Vancouver. These include financial acceleration effects from both domestic and foreign investments and the implications of rising income and wealth inequalities. In regards to the latter, people with higher incomes can get larger mortgages and buy bigger, more luxurious homes. Coincident with increased income inequality in Toronto and Vancouver, price increases in these cities in recent years have been led by more expensive single detached homes. Perhaps an even larger factor impacting house prices in some markets is the weak and lagging supply response. Geographic constraints in Toronto and Vancouver, as well as municipal land use regulation, fees, and extended approval processes are limiting new construction and pushing home prices higher. It is clear that more supply would moderate price increases and alleviate the challenge this represents to home ownership. At 69%, Canada's home ownership rate is among the highest in the world, and that includes countries such as the US, UK, France, Australia, and many other OECD countries. Although more work needs to be done, research from other countries supports the premise that home ownership is associated with positive social and economic outcomes, such as improved education results, greater community engagement, and wealth accumulation. I should caution, however, that much of the research predates the last financial crisis. There is growing concern that escalating prices are putting home ownerships out of reach for many Canadians, including young, middle-income families. This has potential implications not only for these families, but for the wider economy. For example, high housing costs may provide an economic incentive for workers to resist moving from less productive economies to more productive ones. This is very human reaction results in a significant net loss to the country as a whole. CMHC has a mandate to facilitate access to housing, including by supporting the efficient functioning of the housing finance market to enable home ownership, but also to contribute to the stability of the financial system. In pursuing these objectives, we must be careful not to facilitate Canadians buying homes they may not be able to afford. Household debt is at a record level in Canada at 165% of disposable income, and residential mortgages account for about 72% of consumer debt. Our colleagues at the Bank of Canada continue to flag this as a top vulnerability to financial stability in Canada. Concerns have been voiced about first-time home buyers' ability to buy homes. Support should not be unlimited. However, ample support exists for first-time home buyers, including the federal government's Home Buyers Plan, federally guaranteed mortgage insurance itself, and various provincial measures. Too much encouragement to buy a home exposes vulnerable people to excessive financial risk, pushes prices higher where supply inelasticity exists, making sellers better off but not buyers, and jeopardizes our economic prospects. And the last thing we want is for somebody to lose their home. CMHC's most recent housing market assessment report, released just days ago, confirms that there's good reason for concern about housing market conditions. It indicates strong evidence of problematic housing market conditions for Canada as a whole. This was first noted in our fall 2016 housing market assessments. Since then, conditions have worsened in Victoria, although evidence of problematic conditions has eased in Calgary. We have therefore supported the Minister of Finance effort to rein in excessive housing market activities in our role as government's policy advisor on housing. L'automne dernier, le gouvernement...
Last fall, the Government of Canada tightened the eligibility rules for insured mortgages to reinforce the Canadian housing finance system and to help protect the long-term financial security of borrowers and all Canadians. These changes addressed a chorus of commentary from the IMF and OECD, among others, to the effect that the federal government carried too much exposure in housing markets. Notably, a stress test has been introduced for all insured mortgages. The Bank of Canada posted rate, which is typically higher than contract rates, must now be used to underwrite all guaranteed mortgages. This buffer will help offset the highly stimulative effect of low interest rates. Secondly, while lenders are free to offer more flexible terms for uninsured mortgages, government-backed mortgage insurance will no longer be available for any mortgages on properties valued above $1 million or with amortizations beyond 25 years. We expect these macro-prudential policy changes will moderate demand for housing, which will have the effect of limiting price increases, making houses more affordable, and this will support sustainable economic growth.
It is too early to say whether the changes are in fact achieving these objectives. The spring season, which is typically very busy for housing market, will help confirm any long-term trends. Finance Minister Morneau has also initiated a public consultation on lender risk sharing for government-backed insurance mortgages, which wraps up at the end of February. We look forward to exploring this idea, which we believe would result in a more resilient housing system by more fully involving lender in risk management and adjudication. Currently, regulated lenders do not have to hold capital for risk associated with guaranteed mortgages. We are concerned about the misalignment of interests that could result even to the extent of moral hazard in such cases. Lender risk sharing aims to rebalance risk in the housing finance system by requiring lenders to bear a modest portion of loan losses on any insured mortgage that defaults. This will ensure that the incentives of all parties to an insured mortgage loans are aligned towards managing housing risk and further strengthening Canada's housing market and financial systems. At CMHC, We estimate that a modest level of lender risk sharing could increase the typical 5-year fixed rate mortgage by 10 to 40 basis points, depending on the default risk of a particular mortgage. As a Crown corporation with a mandate to contribute to Canada's financial stability, CMHC must be a leader in housing risk management. We have significantly strengthened our risk management policies and practices recently, and we will continue to do so. In the interest of accountability, we have been deliberately more transparent and open in our reporting, analysis, and public presence. We are therefore grateful for the opportunity to be here and to support your work. Thank you.
Thank you very much, Michelle. Turning then to the Office of the Superintendent of Financial Institutions, Ms. Carolyn Rogers, Assistant Superintendent, and Judy Cameron, Senior Director, Legislation Approvals and Strategic Policy. Floor is yours. Carolyn, go ahead.
Thank you, Mr. Chair. And thank you on behalf of the Superintendent and the rest of my colleagues at OSFI for the invitation to be here today. The health of the housing sector is important to the Canadian economy and to the health of Canada's financial sector, and we includes banks, insurance and trust companies, and private pension plans. Approximately 80% of the mortgages issued in Canada are held by financial institutions under OSFI's supervision, and residential mortgages represent almost 30% of the assets held by the banks that we supervise. Our responsibilities also include the monitoring and examination of the 3 mortgage insurers operating in Canada, including my colleagues from CMHC. Accordingly, OSFI keeps a close eye on the risks impacting the mortgage market, such as underwriting and risk management practices of lenders and mortgage insurers, as well as the broader risks, including economic conditions and the interest rate environment. OSFI's mandate is to protect the depositors, policyholders, and creditors of the institutions we supervise while allowing them to compete and take reasonable risks. At a policy level, OSFI fulfills this mandate through 2 key activities: the setting of principles and standards for sound risk management in financial institutions in the form of guidelines and other policy directives, and by setting the minimum requirements for the quantity and quality of capital that financial institutions must hold. OSFI's expectations with respect to risk management practices in the residential mortgage market are made clear in 2 separate policy guidelines. Guideline B20, which sets out the principles for mortgage lenders, and Guideline B21, which sets out the principles for mortgage insurers. Minimum capital requirements for banks and insurers are evaluated by OSFI on an ongoing basis and are designed to ensure that lenders and insurers have sufficient capacity to absorb severe but plausible losses. At an operational level, OSFI fulfills its mandate through a rigorous supervisory regime that combines continual monitoring and an examination process that ensures financial institutions comply with our guidelines and continue to hold capital and liquidity given their respective risk profiles. Like all financial regulators, OSFI has worked hard in recent years to incorporate the lessons of the financial crisis in our policies and our practices. Key among these lessons was that the vulnerabilities that build up in the residential mortgage markets, such as stretched housing valuations and high rates of consumer debt, can lead to financial instability and sharp contractions in economic activity. Deteriorating lending standards at lenders and insurers and financing structures with misaligned incentives can fuel these vulnerabilities. Since the financial crisis, OSFI has made a range of adjustments to both our policy guidelines and our capital requirements for mortgage lenders and insurers. These adjustments reflect the lessons we've learned and the vulnerabilities evident in the Canadian market. Recent examples of these changes include requirements for certain mortgage lenders to hold additional capital for mortgages that are originated in markets where housing price increases are significantly outpacing income levels. We've also recently adjusted the formula mortgage insurers must use to calculate the capital to incorporate a wider set of risk indicators. In addition to policy changes, OSFI has also increased its supervisory intensity of mortgage lending and tightened our expectations around mortgage underwriting practices. Most recently, just this past summer, OSFI issued a letter to the industry reminding them not to be over-reliant on the collateral value of housing assets and to be diligent in assessing a borrower's willingness and ability to make payments on a timely basis. This letter was followed up by a series of targeted examinations. These are just a few examples of OSFI's work with regulated entities designed to promote prudent mortgage lending and insurance practices, thereby increasing the resilience of Canadian financial institutions to adverse shocks and ensuring they are prepared for the unexpected. Before I conclude, I would add that while OSFI is an independent regulatory agency, it does not operate in isolation. At the federal level, OSFI cooperates with key federal agencies, notably the Department of Finance, my colleagues here from the Bank of Canada, the Financial Consumer Agency, and the Canadian Deposit Insurance Corporation. Although each of us has a distinct mandate and role and a distinct focus, we all work in coordination to maintain a strong and stable financial system, a system in which Canadians can place their trust. Thank you for your time. I look forward to your questions.
Thank you. Thank you all for your presentations. Before we go to questions, Ron, did you still want to raise that point?
Yes, Mr. Chair, I understand that the CEO of Canada Mortgage and Housing Corporation had a family emergency and couldn't be here today, but I do think that it's critical for this study that we have him appear before the committee. As a result, and I know that in talking to other committee members, and also I think the clerk had quite a challenge in terms of getting folks scheduled before this committee. So I would like to propose that we agree to set aside at least one more day to hear witnesses, and hopefully we can get the CEO to appear at that time.
Okay, and I do know the CEO had a family emergency, and that's understandable. No criticism there. And I think we had talked earlier as well with some of our members on our side. It seems with the demand that we're getting for witnesses for this study, we will likely have to hold. We're holding 2 4-hour sessions, but we will likely have to hold at least one more, if not 2, so we can talk about, we can, I think, agree that we will at least hold one more hearing, and we'll talk about this as a steering committee to see how we finalize that, if that's okay. And then maybe at that time we wouldn't expect another brief, but if he was here to answer any further questions that might come up, that would be fine. Okay, turning to, well, that's the way we'll try and proceed. Turning then to questions, 7 minutes, Mr. Sabara.
Thank you, Mr. Chair. It's great to be back at work again, or work in Parliament again. Vacation. Let me start off here. I'm going to have a little opening, little dialogue with everyone. So I've taken the time to read the FSR from December and June, and I've also read the CMHC, Mr. Seidel's comments from Vancouver and from London, and the CMHA report. I've also taken an interest in, well, I take an interest in OSFI's work all the time because it's part of my past life. Mr. Rodin's speech on sound residential mortgage underwriting in a changing environment, and which was delivered in last year, November 28th of 16, plus his remarks on bank capital as well, which were interesting. And obviously in lieu with all of our government's actions towards what we've done with regards to the housing market. And I look at this and I say to myself, you know, what worries me? So where's the black swan, if I can use that term from the book? Where's the black swan? Is there one out there? Can we even identify it? Because usually you can't until it's passed. What may trigger some sort of an event in our housing market? And I look at what happened in the United States. We know we don't have ninja loans, we don't have adjustable rate mortgages, we don't have the large subprime market that they had. We have our underwriting standards are top notch, but we have household indebtedness, we have housing market imbalances due to the supply side, and we have a lot of regulatory change that is happening. So when I look at it, I say to myself, well, what event can be out there that may cause trouble for us? And what exogenous event, more so? It could be a regulatory event that we may not unintended consequences of a regulatory action. And it's the exogenous side that scares me. And the simplest one that comes to mind is employment. It's some sort of employment shock to the system. But we know that Canadians, and you see it in auto delinquencies or housing delinquencies pay their bills. We are the best consumers in the world, basically. And you can look at the data, and I've seen it from a past life and follow it currently. And then I look at Canadian housing market, and we are regional markets. Measures that are introduced nationally may have unintended consequences in some markets. Toronto and Winnipeg are two different housing markets. I would argue Toronto and Vancouver are housing markets like London and New York City were 20, 30 years ago, where $1 million purchase price, which is not covered by an insured loan anymore, is just $1 million purchase price. The dream of having a backyard isn't there. You have to move to the suburbs. A lot of the actions our government has taken pertain strictly to the insured market, which is 20% of the mortgage market. 80% of the mortgage market is conventional. Please correct me if I'm wrong. So 20% insured, 80% conventional, uninsured. So the housing price equation is not being driven by the first-time buyer. It's being driven by the conventional buyer, i.e. the low-ratio buyer. So in terms of the housing price equation, to me, it's the housing market imbalances that are of greater concern, the supply factor, not the first-time buyer. So that's my thing. So my question, in a roundabout way, is what concerns us? I understand financial stability is important. Since 2008, we've introduced a ton of measures, B20, B21, and so forth. The new CMHC higher premiums came out earlier this week on mortgage insurance. Sir, Mr. Tremblay, on risk sharing, it's a bad idea. Okay? It's going to result in some mortgage markets in Canada, consumers being dinged 30, 50 basis points, especially in areas where economic growth is not as buoyant as other areas. Okay? So I'm going to stop there. There's 3 minutes for remarks. I can go on for like an hour on this thing, as you can tell. But so I'm going to leave it there. But what black swan, what should we be worried about that is concerning for the Canadian housing market? And I'll leave yourselves 45 seconds each.
We'll give you a little more time than that. Who wants to start?
Well, I'll start. I'm not sure if my swan's going to be as black as you wanted, but I mean, one of the things we've been worried about in the risk scenario that we have in the FSR is really like this idea that you could have another recession in Canada, like an increase in the unemployment rate at the national level that could impose stress on highly indebted households with difficulties in making payments potentially and stress on the financial sector as a whole. So we think this probability is still very low at this point, but as I said before, if this risk were to materialize, the impact would be substantial. The other thing we've highlighted is, term premium on interest rates are very low right now. And we've had risk retrenchment over the past 2 years associated with, for instance, with development in China. So it could be that we have similar event in the future where we see term premium rising, pushing up interest rates and pushing up mortgage rates as a result. And that's one of those scenarios that's a bit more difficult to predict because it involves confidence, it involves risk aversion. And so this maybe speaks a little bit to your black swan.
And we've had a backup in global bond yields since the new president was elected and prior to for about 50 basis points. My concern on employment verification, collateral verification is also should be added.
Yeah, we've noted that in our latest monetary policy decision, this backup in bond yields. I think the situation might be slightly different in part because this seems to be driven by expectations of future growth in the U.S., maybe because of fiscal policy and higher inflation expectations. So it's maybe more driven at this point by fundamentals than just a retrenchment of risk appetite. But
the other witnesses want to respond as well?
With respect to lender risk sharing, that is why there's a consultation going on, is to make sure the government, Department of Finance in particular, consider all the impacts to the system. So we are looking at that. I'm sure they're going to get some good feedback in that.
Carolyn?
I guess what I would add is in relation to your comment about the nature of our regional markets. And I would say that the policies that OSFI has introduced around residential mortgage lending, I would argue, are regionally neutral. A good loan is a good loan regardless of where it's written. It has appropriate serviceability. It doesn't over-rely on collateral. It takes account of the borrower's capacity, all of those things. So I think the fact that there are externalities, there are issues that are unique to some of the housing markets in Canada is true, but I think sound underwriting, sound risk management, and capital reserving appropriate for risk is pretty universal.
Thank you all. Turning to Mr. Albus.
Mr. Chair, and I want to thank all of our witnesses, both for the work that you do every day on behalf of Canadians, but also for your appearance and your expertise here today. I'd like to start off with, first, there's a lot of concerns in my area. I'm from British Columbia. Obviously, I've had people throughout my riding, particularly young Canadians, who felt that they were on a good path towards home ownership, and because of these rule changes, that's been pushed back. I understand some of what you said today, but I think most of us would agree that home ownership has served Canadians quite well. It is a place where people can store away equity and over the long term. And I think we should be very cautious before there's any future changes, as we heard in our pre-budget consultations. Time after time, we heard from credit unions and others that these decisions these changes need to be digested further. Now, I'd like to start off first with a question about these changes enacted by the government. Were they enacted under the Canadian Mortgage and Housing Corporation Act? Is that where their authority came from?
Not to my knowledge, no. I think they're under the legislative power of the Department of Finance.
Okay. The reason why I ask is, obviously, there's not a Canadian real estate market. There are hundreds of real estate markets, some small, some large, and obviously these changes seem to be really constructed to be able to deal with some issues that are specific to places like Toronto and like Vancouver in my home province. The question I would have, besides what some mortgage lenders have described to me as applying a sledgehammer to a very specific problem, were there tools that the government ignored using to be able to apply some of these changes to regions rather than national in scope? Can anyone give some inkling of an idea of whether or not that would have been more appropriate?
I'm not sure. I'm not going to comment on the tools per se, but in terms of the impact across cities and across region, we've done some work on this, looking at who would be impacted, and which cities would be impacted. And what we found is that it's not only GVA and GTA that are impacted, but a host of cities are impacted, and that's because the measures have different requirements in terms of being able to repay your debt. So there's a requirement in terms of mortgage debt, but also in terms of total debt. And it turns out that they're highly indebted households in many different parts of the country. For instance, in Montreal and Halifax, where house prices are low, but consumer debt is very high. And so those folks are being impacted by the measures. And so this thing is a bit broader, if you want. It's really, in a sense, targeting it, having an impact on total indebtedness, not only mortgage debt.
Yeah, but I think we should also note that while this does target, it basically prohibits certain people from being able to get a home and to get into it. That's really what this is doing, is it's pushing that back further. We can spin it however we want. The fact is, we're not allowing people to get into debt because we're not allowing them to get into a home. Is that not correct?
No, that has this impact. At the same time, we want to make sure that people who are buying homes are resilient to future shocks. And so this comes as a stress test.
Okay.
And we completely agree that this has the impact of reducing demand at the margin. But again, I mean, we don't want people to get into loans that they cannot repay.
Now, I think the criticism I've heard from a number of people is that this only taps down demand. David Dodge, former governor of the Bank of Canada, has said there are policy tools to deal with supply to encourage more affordability that way, and I'm deeply disappointed this government still has yet to do that. By the Bank of Canada's own report, they say $6 billion will be pulled out of the economy as far as construction And I think that that's a big issue. But going to the Bank of Canada, and perhaps this might be more appropriate for OSFI, given the fact that certain types of mortgages with amortizations of more than 25 years and refinances, particularly refinances, will no longer be by monoline lenders, non-financial institution lenders, I should say, like the big traditional banks. They will not be able to give loans and refinance existing mortgages. To me, that seems to create a situation where it gives banks an inherent advantage, because if they cannot refinance under these new rules, there's lots of people in Alberta and other places that are economically depressed where people are going to be surprised they can't go back to their existing lender, that they would have to go to either a traditional bank or pay a much steeper price. So are we concerned about that, a lack of competitiveness in Canada?
It's not my understanding that the rules will preclude mortgage finance companies from doing renewals. What the rules do is they reprice portfolio insurance, and that is how some of the mortgage finance companies fund their mortgages. And so it is for finance companies that don't have their own balance sheet from which to fund their mortgages, these will have these recent measures have a disproportionate impact. That is true, but it doesn't preclude any one lender from being able to do refinancing.
Okay, just that about 39% of loans in Canada are done outside the traditional banks, and that's quite a big lump. In fact, when we had a briefing from finance officials in October of last year, we were told that only consultations were done with the larger banks. And so this, to me, because we've received a briefing note, members can see from Dominion Lending Centers, and it actually says that the government is actually taking away the refinance option from Canadians because of these new rules. And to me, hey, I'm just reading what the briefs here say. So I appreciate if you can clarify it, but I'm worried about affordability, and I'm also worried about the competitiveness of the mortgage industry in Canada. Again, we have to be able to give young people an opportunity to join the 69% of Canadians that enjoy home ownership. And I tell you what, it's spinning it that this is simply we're trying to think of people by not letting them get into debt. That's not how they feel. They feel like they're being denied something that their parents and other people are given opportunity to. And, I'd be quite surprised. How much time do I have, Mr. Chair?
Go to your question, that's fine.
No, you know what? We'll have other questions. But as you can see, my constituents are concerned, and I would hope that you guys would be able to lend some clarity to this, or else the study, won't give Canadians the transparency that they need on these new changes.
So I think
Mr. Rogers,
the 80% of the mortgages originated in Canada end up on the balance sheets of banks under OSFI supervision, of larger banks. What Dominion Lending Centers is describing is the origination of mortgages. So there's a difference between who originates a mortgage and who ultimately funds a mortgage. And it's the funder who ultimately holds the risk. So regardless of whether the mortgage is brokered or originated by a broker or not, for the most part, the mortgages in Canada are held, the risk of those mortgages are held in the banks. The challenge that the Dominion Lending Centre is communicating to you is that the options available to brokers on where they can send their mortgages are reduced when some of the finance companies are less able to fund their mortgages through portfolio insurance. So it's more common for finance companies to use mortgage brokers than it is for banks. So measures that affect mortgage finance companies by design affect mortgage brokers. That's what that brief that you have is telling you.
Do you want a supplementary on that? You okay? I know you're out of time, but this is a fairly good point. Mr. Caron.
Merci beaucoup.
Thank you very much. I will begin with Mr.
Leduc, referring once again to household debt, to that issue, and the various components that come into play, including mortgage debt. But I do remember that in the last legislature, the government was saying that this wasn't that important because the net value of households was also growing. And at one point in time, I think we were richer here in Canada, household-wise, than households in the U.S. My argument has always been that a good portion of this wealth of households does flow from the value of houses, the value of mortgages. We can't really at present determine whether or not there's a bubble or not. Each and every one of us has his or her view on this, but we know that there is a bubble when it starts to deflate, and especially when it is completely emptied. But I would like to know if the angle of the net value of households is a parameter that we can take seriously. We're worried about household debt. Can we be reassured by the value of households? Or this component flowing from the value of houses, is it a problem in itself? Indeed, this is a question that is always tricky. It's difficult to answer it because it does involve speculation and the impact this can have on markets. In the last review, the most recent that we published in December, we noted that there are a lot of factors indeed that underscore the assessment of values, fundamental elements, demographics, interest rates that are low, mortgage rates that are low, the constraints with regard to the supply, which we've previously discussed. These are all factors that do sustain the value of houses, and these are factual elements. But in June, as well as in December, we underscored yet again that we are concerned at the bank by the fact that there are expectations that might self-realize. People think that house prices will increase, so people purchase it earlier than they would normally, and we don't know what the impact might be if there is a shock on the market. So this is a concern for us that remains. Nevertheless, there are fundamentals that are there that are sustaining the price of houses in the Greater Toronto, in the Greater Vancouver, job-wise, income-wise, etc. Notwithstanding that, we do still have concerns that flow in with what you have outlined. The measures taken by the government have been somewhat criticized. I think that they were well welcomed in certain markets, favorably seen, and the danger was that there might be a perverse effect in other markets. In Quebec, where accession to ownership is below the Canadian average, there is no real estate bubble in Montreal, Quebec City, or elsewhere in the province. And our fear is that the measures taken, in fact, will be an extra obstacle to ownership. I don't want this to be partisan, but I'd like to know that if, in your opinion, the government has done its utmost with regard to restricting conditions for access to ownership or mortgage. We don't have very much data. These are relatively new policies that we haven't seen put in place in many countries. It's difficult to assess their impact based on the tools and data we have. So, whereas to know if they've gone as far as they could go, before answering the question, we'd have to study the impact of the measures. And this is one of the reasons why, if we look back to October when we published our report on the monetary policy, at the time we'd said that there was a lot of uncertainty with regard to the measures. We're expecting that this will remove about 0.3% from the GDP between now and 2018, but we do know that there's a lot of uncertainty because we don't have very much experience with these measures. And therefore, I think that what we have to do now is to wait and see where these measures lead. I have another question, most probably for the Office of the Superintendent of Financial Institutions, but I will also give you the opportunity to respond on behalf of CMHC, if you do have an answer in this regard. As Sylvain mentioned, it's a little too soon. We've just had a few months' experience with this to determine its impact. To date, the volumes at CMHC are relatively constant, but a lot of factors are going to be at play versus 2015, so it's a bit too soon to answer. Thank you very much. I think my question is for you. I think you're the best place to answer. Using RSPs to buy one's first house or home. This is a measure that's beneficial in the sense that it gives people the opportunity to use present savings to access home ownership. But some economists, some fiscalists, have said that there might be a possibility of, in fact, creating more supply than there should be, because you might transfer amounts of money to your spouse to buy another property. Is this something that you've seen? The use of that possibility to use RSPs to purchase a second property within the same household, because the two spouses are considered to be individuals in their own right.
I apologize. I'm going to answer it in English. And I'm actually not going to answer it really because I don't think I have appropriate data I don't think that's a piece of information that our office would necessarily gather.
Just last question. Do you know who could answer my question? Is it the CRA? Is it the bankers? Who would be in a position to actually give me some data on this?
I imagine the banks would have it, because if I understand your question, you're looking to determine the usage of RSP programs for down payments and whether they're being used for primary residence or second houses. Is that right? I think it's the banks that have to track that information. They would have it. It's not a question necessarily pertinent to our prudential mandate. I can ask at the office to see if it's data we have. I suspect not, but.
If you could, if you do have information on that, Ms. Rogers, just send it to the clerk, and we'll provide it to the committee. Mr. Greywall.
Chair, and thank you to our witnesses for coming today. If you look at the data, 7% year-over-year increase in prices, but if you remove the GTA from the data, it's flatline across the country, which I found very interesting. I think that we're well regulated in the housing market, and I think that the latest regulations from the federal government were the right thing to do to control the temperature in the housing market. My concern is, are we asking the right questions? So, in terms of foreign investment, and I don't know if you will be able to answer this question, but this is something I'm concerned with at a local level and on a broader macro level across the country. Does the data track if a foreign investor buys the house in cash? So if somebody from China, for instance, or anywhere in the world, to be honest, purchases a property in the GTA or anywhere in Canada and pays cash for it, is that data tracked in terms of foreign home purchases?
Anybody willing to take a stab at it, or if we don't have the data, that's fine. That's all we need to know. Mr. Lawrence.
So CMHC has done some survey work to cover the extent of foreign investment in condominiums, and typically, the percentages are very low. And we don't make any distinction whether it is through cash transactions or with or without mortgages. So there's that bit of information, but we don't track cash per se.
So my follow-up question would be this, is that if there was a restriction on foreign countries, specifically China, on taking money out of China, so restricting their citizens from removing the money, how would that impact the Canadian market?
Well, I mean, the data, we don't have that much data, and the data I'm going to quote is you probably know it as well as I do. But so before these policies, the taxes were implemented in Vancouver, I mean, about 10% of purchases were done by foreigners, and this has fallen. We know by now this has fallen to about 4 or 5% in the latest data. So that's about the range we know about in terms of that magnitude. And of course, I mean, we don't exactly know where the data is coming from internationally, but restrictions on movement would have an impact. It's difficult to gauge by how much, but it would impact that 10%. So this is about as much as we know, I think, from the data.
Thank you. My last question is to the Office of Superintendent, the OFSI. You monitor how lenders are doing their practices, how they approve mortgages, how they decline people. My question is this, is that on a practical level, as Canadians walk into a bank or a mortgage lender and they apply for a mortgage and they have to prove their income, I've heard of stories, especially in my neck of the woods in Brampton, that income verification isn't as stringent as it needs to be, as in that the documents are provided and that's it, and that there's no follow-up calls, there's no practical analysis, and that fraudulent documents are having a big play in mortgages being approved. And this will very much would be a regional problem, but is this something that your office is looking at? Because if I feel like there's going to be a risk to this whole thing, is that people that are fraudulently getting mortgages, yes, they may be working on cash businesses, they may have the money to meet their short-term requirements, but if something in the economy changes, for instance, if we have an economic slowdown or resource prices start to go down, those people will be the first ones to get up and leave. And that's not to the extent of what happened in 2008, but that's a real risk for the Canadian market in certain regions.
Yeah, and your question is that something that we pay close attention to? Yes, absolutely. The letter that I mentioned in my opening remarks included comments on exactly that issue, reminding lenders that it's very important to be diligent about assessing a borrower's capacity to repay, and particularly where that capacity may be originating outside the country or from sources other than sort of a kind of a typical paycheck where you can look at a pay stub. So it's something we pay close attention to, absolutely.
I would further say that right now, and correct me if I'm wrong, I could be wrong because I haven't dealt with a transaction since I was elected, but I was a corporate lawyer before. When you provide the bank with notice of assessments, they take them for what they are on the paper. As in, they don't pick up the phone and call the CRA to double check that income. And I've seen fraudulent NOAs out there, and I think that is actually a real risk to banks and how the housing market, if there is a risk to the housing market, this may not be a major impact, but it definitely will be an impact. So it's something that I'd suggest all of you to look into. Thank you so much.
Any further comments from anyone? Just to follow up on the cash question, if I could, in terms of data collection, in terms of housing stats and the pressure on housing prices, does it make a difference if the payment is in cash or if it's through a mortgage lender in terms of the data collection? Do we have that information on cash purchases? Do we know? I mean, I do know from in my own area in Prince Edward Island, there in fact is a lot of cash purchases in the tourism industry in terms of purchasing some of the tourism businesses, and it's cash. It's documented, but it's cash. And so I'm wondering, in terms of the housing market, relative to Mr. Aywal's question, is that data collected? And because it would be important to know in terms of the pressure on the on housing prices, it would have an impact. Does anybody know?
In my last job, I was in British Columbia. We were looking at this question in earnest a year or so ago. We determined about the best or the closest thing to a source of information that would give you this is in the real estate sector. They'll track through their contracts of purchase and sale. But I don't think that what we found in British Columbia is it's not aggregated anywhere in a way that you can do any form of analysis on it. To your first question, Mr. Graywell, I think the only jurisdiction that is tracking purchases according to the source of the income, whether it's foreign or domestic, is British Columbia now, and that was only since June or July. So.
Okay, maybe, Mr. Lawrence.
I would just like to add that we're in consultations with Statistics Canada to look to collect that kind of information, starting with information from land registry data in the larger census metropolitan areas across the country. So we may not collect the data right now, but we're in the process of putting forward a proposal to collect such information. Whether it is cash or through the use of mortgages or not, we would collect that information.
Okay, it's something we'll have to keep in mind. Mr. Leipert.
Thank you, Mr. Chair. And thank you to the witnesses for being here. Although, Mr. Chair, I think I just wanted to make a comment that I think would be helpful going forward when we do these sorts of studies is it would be, to me, it would be much more beneficial if we had these folks here after we heard from all of our witnesses so that they could answer some of the statements that have been made by witnesses that we could ask them about. So I just think as a committee it's something we should think about going forward. I want to first focus a bit on policy development. I'm always interested in how policy is developed, and you know, this situation seems to me to be one of these, there's an old saying, hi, I'm here from government and I'm here to help. And so I'd be curious to know if you could help us with the development of this policy. Is this something that the finance minister said to each one of your organizations, this is what I would want to do, and do you think it'll fly? Or is this something that each one of your organizations would have gone to the Minister of Finance and said, we see an impending problem here? So I'd just ask each one of you how you would respond to that.
Who wants to start? Bank of Canada?
I mean, this is, as I mentioned, the imbalances in the housing market, the vulnerabilities with indebtedness is something we flagged for, I think, about the past 2 years. So it's something that's really been concerning for us in terms of financial stability. In particular, the indebtedness. I mean, the two really work in tandem, if you want. House prices are going up, people are reaching maybe a little bit more and getting a bit more indebted. And the fact that the indebtedness is rising the most for highly indebted people is really worrisome. And, you know, because again, like the macro conjecture might change very quickly, putting people under stress, under duress. And so having to repay their loans, their debt might be more complicated, putting stress not only on the macroeconomy, but also on the financial system as a whole. We think, again, that these risks have a low probability at this point, but again, could have material impacts, and so something clearly to watch for. So I think these have been something we've been really preoccupied with at the Bank of Canada over the past 2 years. And I mean, our way to flag this is through our financial stability review. That's our tool. We're not, as you know, overseeing banks per se, but we have a seat at the table with the senior advisory council, and so we provide advice to the Minister of Finance through that mean. But really, to try to maybe stir the debate in different direction, we use our financial stability review.
Others?
Yeah, as I said in my opening remarks, each of us here today has a very distinct mandate and a role to play in the financial sector, but we work very closely. There's a number of committees, some of which are actually empowered in legislation, where we share information. And then we just have a close working relationship amongst ourselves and with the Department of Finance. So when policies that will impact our roles and our day-to-day work are being developed, we provide technical expertise when asked, and we share information among each other too, to support each other in achieving our mandates.
So we have ongoing discussions with the Department of Finance on these issues, and similar to what Sylvain has mentioned, obviously the vulnerability of household debt has been a concern of all three of us, but the Department of Finance also. So we've been having ongoing discussions over the last few years on this file.
Okay, so obviously the policy development was on the advice and discussion with each one of the three organizations. So in those discussions, did you ever give consideration to something other than a one-size-fits-all? You know, I represent an Alberta riding, and I can tell you that this has caused a great deal of problems, as it has to Mr. Caron's province of Quebec, Mr. Albus's province of British Columbia outside the Vancouver region. In Alberta, I've talked to builders recently, and their new housing construction has dried up. We have enough problems with unemployment in Alberta, and now this is just going to layer on another problem with unemployment. So did you give any thoughts? Did you make any recommendations about doing selective areas to address a problem that existed in what I understand is 2 specific areas only? And if you didn't, why not? And if you did, was it rejected and said, no, we're going to do one size fits all?
Let's start. Ms. Rogers, go ahead.
I'll bite. Our role at OSFI is to give advice relative to our mandate, so that's the protection of depositors and policyholders, the stability of banks, basically. So we talked to the Department of Finance about a narrow slice of the many policy considerations that somebody in their chair needs to consider. Having said that, I would say I guess I don't view the changes as one size fits all. I think where they have a common impact across Canada, it is where there is common vulnerabilities or common risks across Canada. So as I said earlier, sound underwriting is sound underwriting, and where there are differences in the risks in regions of Canada, there is nothing in OSFI's guidelines that preclude the lenders in those areas from reflecting those risks in their policies. So we don't dictate that a rule has to be the same, or a risk appetite for an institution has to be the same across Canada. So, and in particular, I would draw your attention to recent changes we've made to capital requirements for banks, where we have targeted the policy. We have told banks that mortgages in regions where housing price appreciation is outstripping income, they should be holding more capital. And in regions where that's not the case, there is no expectation for that additional capital. So I think where it makes sense to have targeted policies where the risks are differentiated by region, we have done that. Consumer indebtedness, as Sylvain said, is not unique to Vancouver and Toronto. It's a concern across Canada. So it's something that we watch in all regions. So.
Either.
Go ahead, Mr. Leduc.
Yes, I mean we're as my colleague just mentioned. I mean we think targeted policy are always better. So that's why we prefer macro-prudential policies, let's say, than monetary policy for a reason you highlighted. Monetary policy, for instance, would be a very blunt tool to deal with financial stability issues compared to more targeted policies of the form that have been introduced, and they quite clearly involve trade-offs. And again, in our monetary policy report of October, we've highlighted that this would the policy would have a negative impact on GDP growth potentially over the next 2 years, subtracting something like 0.3% to the level of GDP by the end of 2018. So it's something we're aware. Whether it's one size fits all, again, as I said in our financial system review, we've noted that that the policy would have an impact not only on the GVA and the GTA, but also on other regions where debt is consumer debt is very elevated. So they buy it because of that, not only because of house prices. So because we've been concerned by household indebtedness, this is something we've highlighted in the RSF.
Mr. Leipert, you had a quick supplementary. We're over time, but go ahead.
Probably more of a comment than a supplementary, but one of the things that I abide by in political life is I never answer a question that starts with if. In looking through your reasoning behind making this policy recommendation, I have seen nothing but ifs ahead of the rationale for making this decision. If unemployment goes up, then you say the risk is low. If something else happens, then the risk is low. I just don't understand why this kind of a blunt instrument was used, because certain people from government are here to help, to say you're in over your head. That's my comment.
Miss O'Connell.
Thank you, Mr. Chair. Thank you all for being here. I guess following up a little bit, not really a surprise. I somewhat disagree with my colleague. But in terms of the targeted approach versus a one-size-fits-all, I somewhat see these changes in borrowing to be a more targeted right or approach, because, and correct me if I'm wrong, if I'm understanding it, that it's all relative. And if you're it doesn't matter if the housing market or the price of a house in a relative market, but it's your indebtedness level. So if you're in debt in PEI, or you're buying a house in Toronto, but you have low debt, that's where you're going to come into issue. If you don't have high indebtedness, then it doesn't matter the market you're in, you'll be able to deal with this. If your debt is too high to your income, then it's a big risk that the government is concerned about making sure that the system doesn't crash, essentially, or that you can still pay your bills based on your relative income. Where I see a larger concern is when you see, with all due respect, I have no qualms about the fact that, for example, when you see in BC or in Vancouver and you see these approaches happening, and from those governments, I'm sure it's incredibly important or what's needed. But me coming from the GTA, when you deal with something in one place and then it just pops up worse in the other. And so we're actually seeing where in Vancouver, where the market is, and it's still early days, but there seems to be some indication or some acknowledgement that some of the recent changes for foreign investment or empty houses is working. The increase in Toronto and the GTA, where I'm from, is actually increasing. So how do we deal with creating a system that is fair and controlled without having individual markets also get involved that then put the pressure on additional markets? So it's somewhat of a very broad statement, but I think I'll get to I think the more appropriate question would be in and around where Mr. Greywall's questions were going. If you're not tracking foreign investment, for example, cash, then you're not really highlighting some of the risks. There are areas within the GTA that if the Vancouver market has now shifted there, if we're not tracking this foreign investment in cash payments, are you really assessing the risks that are trickled and associated with it? And the first being appraisal prices, value of homes. How are you, or are you confident in the appraisal process if homes are being bought in ways that are not even being tracked? Anyone who wants to jump in. It's a broad question, so anyone who has an opinion.
No, in terms of the relationship, of course, in theory, you would think about that. And if a tax is imposed in Vancouver, for instance, investors that are affected would have an incentive to try to maybe shift to other cities or other places for a roughly comparable investment. I think the one thing to keep in mind here is that, again, there are many factors that are underlying house price growth. And it's not only foreign investment. Foreign investment is one part. What we have so far is that it may not even be the most significant part. There are demographic factors that are really important. There are interest rate factors that are important. There are supply constraints that are important. And so, just looking at GVA and GTA and seeing one still going up and the other one maybe having early signs of cooling off, I think it's too early to just ascribe that to a particular source. And we just have to be cognizant that these factors are really underlying the two markets.
Yeah, on the foreign purchases element, so these types of measures have been tried in other countries before. Hong Kong is a classic example where they've tried this. And what typically tends to happen is house prices kind of tend to stabilize after these measures are put in, and then they just start picking up to grow again. And usually the reason behind that is that there are many factors that are driving up house prices, and maybe foreign purchases are one of them. But it's a much more complex, many other factors that are doing it. So these measures, they're definitely not a solution to that issue.
So you raised the specter of appraisals. So we are definitely comfortable with the appraised values of the stuff we insure at CMHC, and I'm sure that our competitors are also doing their due diligence in terms of the appraisal values, and to just support my colleagues in terms of the house price escalation, the price increases. There are a variety of factors, and foreign investments has been getting a lot of press, but it's not necessarily the biggest driver of house prices in Canada.
And you feel confident in that, even knowing that we don't collect all the statistics for example, for cash, which if this is an investment property and people can afford it, how do we know that that's not a bigger problem than it is if we don't actually have that data? And it might not be a bigger issue, but how do we feel comfortable in that?
Again, I guess we don't track the data for foreign, whether with mortgage or without mortgage through cash. We are looking to collect that information, so we recognize that there's a data gap, and we are looking to fill or address that gap. What we do know from our own analysis is foreign investment is a factor, but not necessarily a large factor. In fact, if you look at it, you could also say that some of the surge in pricing in Vancouver, Toronto, can be attributed as much to domestic investment as foreign investment, and so that's something to look at as well. So.
I think, though, depending on specific areas, and the problem will be is that direct or foreign investment might be isolated in very specific neighborhoods, for example, and then what are those impacts when you have high concentration? It might be nationally a very low risk or not a big issue, but when it's highly concentrated in entire neighborhoods, and I know them offhand, not so much in my community, but right next door. And when that high concentration exists, are there further risks because it's not actually evenly spread out in a small amount nationally? So that would be my bigger concern when it comes to the foreign investment, is that I agree it's probably not the highest risk, but that concentration level, and what does that mean for those communities? If I have time for one more, I have I'll
quickly,
go really,
we
really
seem to
quick.
have lots of time, so go ahead.
Oh, okay.
But quick.
My question is similar to Mr. Graywell's again, but I read a study, and again, I don't know if this is actually true or if it's credible, but essentially, because it was self-identified study, but the idea that young people who want to enter the market for the first-time home buyers are actually asking parents a lot for their down payments. That's fine if their parents have cash, essentially, but if their parents are taking out loans or lines of credit and saying to their kids, here, you can use this, but just make the payments. But that amount is not really being accredited to them in terms of their indebtedness, because they'd be walking into the bank with a certain amount of cash, essentially. How is that being factored into ensuring that indebtedness level is not just being offset by other means that is further debt, and if interest rates were to rise, they would rise on both ends. So where are the checks and balances from to the institutions to ensure where that down payment is actually coming from, in terms of that it's not a further loan just by other means?
You didn't think that was a quick question. Go ahead. Who's got a quick answer?
I think I can give a short answer. The underwriting requirements that most banks have in place look for the down payment to be not in the form of debt, right? So if it is in the form of debt, then that debt gets factored into the overall debt service ratio, and these are the measures that were recently tightened, particularly as it relates to insured mortgages. So lenders are meant to factor in the source of the down payment and whether or not that source is further debt. So now, whether or not Bank of Mom and Dad would adjust the interest rate at the same way as conventional lenders is something that's always hard to predict. But
okay, thank you, Mr. Elbouteif. I would say to the parliamentary secretaries, because we normally have 6 witnesses and we've got 3, there may be time if you have a question, either one of you, so just raise your hand. Mr. Elbouteif.
Well, thank you very much. This situation, we see a blanket policy over the market, over the lending and all that. And we know that what triggered this whole policy is Vancouver and Toronto. The bubbling market, the hot market in both cities have triggered this whole policy, in addition to the measures that we took when we were under Prime Minister Harper's government. Now, the outside Toronto and Vancouver, we hear now in Alberta from builders, small builders, 10 houses, 15 houses, that they're selling their units without a profit. They're letting the profit go. They're going because they can't afford to keep those units there because there's no buyer to qualify for these units. So the question is there a flexibility in the policy? And have we regarded other markets other than Vancouver and Toronto in this policy? And how can we really make sure that the policy itself, if it makes sense, which is we believe makes sense in Toronto, makes sense in Vancouver, but it's going to hurt other places in other places, other cities, major cities in specific in Canada. So there's some unanswered questions out there that we'd like to have some clarification, and whoever wants to participate to the answer will be thanked.
I do know some of these questions, because back to the what if earlier, Ron, some of these questions really amount to more government policies. Part of the mandate of these 3 agencies that are here are actually to deal with the what ifs, and some of the general questions are more along the lines of that a minister should have to answer, but in any event, you do provide advice. So who's starting? Mr. Leduc?
Well, in terms of tailoring, I mean, if we want to have policies that are really tailored at the specific markets, I mean, they would have to be more along the lines of provincial policies or municipal even policies. But I mean, that's we've had some of that, but that's the only thing I can really offer here. And again, I would go back to the idea of indebtedness and the fact that indebtedness is not only due to mortgages, but also to consumer loans and some people have high level of debt because of that, and that's an important fact to keep in mind.
yeah, I think. I mean, there's been a range of policies. So I guess the other thing that's difficult when you talk about any one of these policies, but in general, the things that OSFI has done and some of the recent things that change the mortgage insurance market are actually not designed to target housing. They're designed to target debt related to housing, and we take an interest in it because that debt, as I said, is 80% on the balance sheets of the institutions that we regulate. So I think looking at these policies and through the lens of what are they doing to housing is in my view and probably in my colleagues' view, not the lens that we tend to look at them with. We look at how they affect mortgages, not the houses, and how those mortgages then affect consumer debt and how they affect the risk profile of financial institutions and then the broader economy. So you know, we may be sort of talking apples and oranges here in terms of you know, their effect on the actual housing market relative to their effect on consumer debt or the mortgage market.
If I can, yeah. So yeah, just that, in that way, the focus on debt, I think the policies go far beyond the idea of preventing a particular household from getting itself in trouble. So the concern here is that there's enough households that are highly indebted, and we should have the misfortune of, say, have a rising unemployment rate around the country, that fact that households are highly indebted will make the circumstances even worse in the economy. And in a worst case, increase financial stress in the financial system. And that just comes back to bite the original people that we're all trying to protect in the first place and make the system safe.
Yeah, if there's a sudden sharp rise in interest rates, which I think is a genuine risk, whether you live in Kelowna or Greater Toronto or Greater Vancouver region, you know, interest rate policies aren't regional. So the cost of your mortgage payment will go up. And if you have entered that mortgage already stretched to make your payments and the interest rates go up, that's going to be it's going to put an enormous amount of pressure on consumers, which will in turn put an enormous amount of pressure on banks and insurers, which in turn will put pressure on the economy. So that tends to be the lens that we look through it. And I don't think that's regional. I don't know how you would fix that on a regional basis.
We'll give you another.
We've got the default rate is only 0.28% in Canada, which is very safe. It's very low. And seems like we have lack of statistics. And I'm not pointing on anyone. I'm saying here the Minister of Finance and the Finance Department have to look, they're going to have to listen to your opinion because you're on the market and you're somehow dominating certain areas of statistics that is going to be helpful to shape up any policy that is going forward. So in that fashion, we're saying the default rate is very low. So why is the hurry to have that blanket policy across Canada? That's one question. And do you have any statistics on the effect of these measures on residential construction, on GDP, and unemployment? It's very important. Those very legitimate questions that people need to know, public needs to know, and we need to know. Can anyone give us an answer here, please?
On the last question, if I understood correctly, just in terms of the impact on GDP, yeah, we subtract about 0.3% to the level of GDP by 2018. So that's you know that's the impact we have. As I said, there's a lot of uncertainty around that number, and we've noted that just because these policies are relatively new, we don't have a whole lot of experience on which to base.
So that's about $60 million.
I'm sorry.
About 60 million.
About 60
million.
I'm not.
Yeah. Okay.
So that would be about that rough impact. In terms of the default rate is low. I mean, you know, I think this is meant to be preventive. We don't want to implement policies while the default rate is really rising. That would be probably problematic. We want to put the policies, I think, in place before we have to deal with these problems. I'm sure the U.S. would have liked to have had these policies in place before they dealt with the subprime crises. And so I think that the idea of prevention, which we've seen over the past, you know, through 2008, where, you know, different governments introducing different macroprudential measures, I think is important.
Yeah, I mean, I would come back to the first question this afternoon from Mr. Sobera about what do we worry about. I mean, I'm a regulator, I get paid to worry, but my biggest worry is that we keep thinking the history is what's going to happen in the future, and we get complacent, right? So I think we get asked that question a lot. Banks will often point to their historical default rate as a reason they don't need to hold as much capital or be as careful going forward, and you know, our position is, you know, always that your default rate is your rear view mirror, and you need to be looking in the windshield. So That's how we approach both our risk management and our capital reserves.
Thank you all. Mr. Whalen, welcome to committee.
Thank you very much, Mr. Chair, and thank you each for coming. As Canadians, we rely on your institutions to give us confidence that the markets are functioning effectively. And as parliamentarians and policymakers, we rely on the evidence you provide to help us make sure that our policies are going to help make the economy better and not worse. And when Mr. Cervera asked, do you think the number one risk is, I have to say that, I would disagree with some of the things that were put forward, and I hope that you guys can convince me that my concern about the number one risk is wrong. And my concern about the number one risk is the aging demographic of baby boomers have been holding on to their mortgages longer through the use of reverse mortgages, tightening supply in the housing market with those tools, driving home prices up as a result of that tightening of supply. And then, of course, as they all pass on with higher levels of debt associated with their homes, they're going to release all that supply back into the market very quickly over a 20-year span, starting very soon. If I look at the numbers of people aged 0 to 20, it's about 7.9 million. If I look at the number of people in Canada aged 50 to 70, it's 9.64 million. And so you see this extra supply of housing as those people move out and the new generation coming in to take the supply is not enough. And I'll leave immigration aside for a second, but also this new intergenerational problem we have is that these mortgages or these homes that are being released back into the supply are coming in with large amounts of debt associated with them, not the same as in previous generations. And so I ask Mr. Leduc, when you say that you've conducted model simulations to analyze the effects of such a shock and found the buffers in the Canadian financial system would be sufficient to absorb its impact, you're talking about your view that it's unemployment rates coupled with increased debt and a rise in interest rates as being your number one concern. Can you just give me some comfort that you've actually analyzed the situation that I've laid out and that it's not a bigger risk than the one you've raised, and you've modeled my concern?
I'm not sure we've modeled exactly your concern, but the stress tests we conduct are really potent. I mean, we really look at scenarios that are dire to really make sure that the financial system is resilient to shocks that are maybe unlikely, but if they were to happen, would be really substantial in terms of their impact. So I'm not sure we've dealt really, to be honest, in terms of reverse mortgages. I don't have like a whole lot of knowledge about that specifically.
So you haven't modeled
in terms of the supply.
You haven't modeled my concern about a 5% increase, like 5% of the population change and all that?
Not in terms of demographics, but we've dealt with substantial increase in mortgage rates, let's say through term premium increases, substantial increase in unemployment rate, that type of thing.
Okay. So do you think your institution has the intergenerational data? It's never reported. When we talk about these important numbers like debt-to-income ratio, it's always reported as one number for the entire population. But of course, there's going to be huge variability of that number over the lifespan of citizens. Do you guys have the data available to you on what that number is for every 5-year demographic, what that number is? Have you seen any problem or any blips that have happened in that cohort of people that are just about to retire or who have just retired, where they're carrying significantly more debt than they used to? And should we be concerned about that as part of our housing study?
Yeah, so we do have data on that, and so we think about that. These demographic factors as being a longer-term factors that kind of happen more gradually, and you raised some really good points. As part of these stress scenarios that we're focused on, there are more short-term, more things that can happen in the next few years that would happen abruptly, a big change, like a big rise in the unemployment rate or things like that. So yes, we have that data, and I'd have to get back to you on that, but that's not been a part of our scenarios. Because it's not something that we would see happening in the next few years, or next, say, 4 or 5 years.
Okay, so when I think about the housing market, I think in generational terms because it's a generational investment. You're hoping to get into your house and raise your family and then move into a smaller property or not when you retire. So in terms of that aspect of the market, I'd love to have the thoughts of your group on that question that I raised. And if you haven't considered that sort of like climate change type scenario where the whole sort of nature of the Canadian housing market changes over the next 20 years due to the the retirement and the demise of the baby boomers. I'd love to have your thoughts on that model scenario, because that's the one that keeps me awake at night. Thank you.
Lawrence, go ahead.
At CMHC, we do have done some long-term demographic projections, and these are based on census data. And so we look at cohorts over time and how their demand for housing evolves. And from what I can remember is going out as far out as 2020, 2030, there's still an ongoing demand for more housing. So even if the population is aging, the number of units continues to rise. And a big reason for this is immigration. There continues to be large inflows that offsets that contributes to demand.
Thanks, Mr. Lawrence. A quick follow-up question. There's many regions of the country where the immigration is net neutral or negative. And so when we look at long-term housing policy, should we be differentiating our policy between those markets that are growing as a result of immigration and those which are contracting as a result of no net or falling migration patterns, and those that are neutral, and stop considering Canada as a single market as a result of this, more, pronounced issue?
We've started going down that path in terms of looking at it from a provincial perspective and even from a large centers versus rural areas. From what we've seen as an example in the Atlantic, our estimations, our projections are showing that the Halifaxes, the larger centers, continue to grow, but that those in the rural areas do not. So there is some shifting of populations towards the larger centers, and those continue to grow. So there's that going on. We will continue to do this, though, in other centers.
Thank you. Turning then to Mr. Caron, and then we'll come back to Mr. Sabera, and then anyone over here on the Conservative side. Mr. Caron, 5 minutes.
Merci. J'aimerais prendre quelques...
Thank you. I would like to come back to a few elements that were mentioned earlier by Mr. Leipert. There was also the demographics issue that was brought up. The measures announced, taken by the Department of Finance, involve the supply, basically. So the supply increases because of X, Y, Z factors, and we want to control the supply, and this is the role of the federal government. The problem is that by having an impact on demand, you're also having an impact on supply. We're talking about new builds, and in Quebec, in passing, we think that there's going to be a drop of about 10% next year, in great part because of the measures taken by the federal government. On top of that, we have the demographic aspect, because more and more there will be house sales, so no need for new housing starts. My question is, if the federal government can do this, how can it truly have an impact on demand? Because the situation varies from province to province. And this leads me to my second question. As federal MPs, we like to give a lot of power to the federal government. But mightn't there be a way of giving greater power to the provincial governments, given the fact that the reality province by province, or at least region to region, varies? The decision or the measures taken by the federal government can be positive in some sectors and extremely negative in others. Why is it that the federal government would not be able to encourage the different provinces, even assist them, in facing specific realities that they experience? My question goes out to any one of you who wishes to answer. More particularly, perhaps the bank or CMHC. First question, is there a way to have an impact on demand without impacting supply? Otherwise, the two measures will cancel each other out. Second question, would it not be desirable that the federal government react directly in the market and help the provinces intervene in the market? Both issues are related, but it depends on the speed with which housing starts can be launched. Therefore, there's a reaction time such that demand can be more impacted upon than supply short term. Clearly, in areas such as Vancouver, Toronto, where there might be more constraints for housing starts, perhaps more of an administrative time lag, not just physical delays, but also administrative delays for the approval of various plans, etc., that can play out. So these measures could have more of an impact on demand short term rather than on supply. Obviously, the two long term will interact. There will be anticipation price wise, which will have an impact on supply, but short term in some markets, it seems to me that the impact will be more on the demand side than the supply side because of the delays for approval of building plans, construction plans, and projects. Our analyses suggest that demand can be impacted upon in various centres, but supply doesn't react as quickly in Toronto, Vancouver, compared with other areas. This is what we see. The idea is that there might be some discussion to see how to help supply react to demand. So there could be benchmarking between municipalities, and we could determine where things are going well and where they're not going as well. The Fraser Institute came out with an analysis looking at the various parameters, regulations, etc., in various centres to show that in some areas things are going better than elsewhere. So it's a matter of sharing knowledge and improving the ability for supply to react to demand throughout the country. Another quick question, because if we look at Vancouver in particular, we saw a reduction of the demand thanks to two measures taken by the federal government with constraints, rules for access to ownership, and the measures taken by the provincial government with regard to the sales tax on purchases from foreigners, by foreigners. Might there be a way to separate the impact of these measures to determine to what extent the increase of the sales tax has played a role or can play a role in order to achieve the desired results, and to what extent it's the federal government's measures that played a positive role? Can we do this? Has there been an attempt to do so? It's a very temporal, so we can have models to study this, but it's very time sensitive. So we need time to determine if the impact has been positive. With financial data, it's always trickier. Empirically, it will be very difficult to do. That's my impression. But we could perhaps get a good picture of this based on our models, more theoretical, however. That's what we'd like to see as well. Thank you very much.
Sabero. And I know who's over here.
Thank you, Mr. Chair. Just a couple of follow-up comments. You know, when we look at the Canadian housing market, one of the really, really good things about our market is about 40% of homeowners actually don't have a mortgage. I think the last time I looked, the numbers around 37% from my rating analyst days. But I think we're around 40% of all homeowners in Canada don't actually carry a mortgage, which is a great thing. The other thing is our interest expense isn't tax deductible like it is south of the border, so it encourages Canadians to pay down their mortgage as quickly as possible. Other great thing about in Canada is for the GTA, we have about 100,000 new folks that come and want to live, work, study, raise a family in the Greater Toronto area. The downside is we have a housing market imbalance where we don't have the supply of new housing coming on market, taking a very long time to get on market, whether it's due to municipal rules, to land zoning issues that have come down from the province onto the municipalities. So there's a housing market imbalance, which is the supply side, demographics, which are support housing growth because there's so many new folks coming in, whether they're immigrants or just people moving from different areas of Canada. And we've come and now put some measures in. So my question is, with the new measures that have been introduced, if you want to go back to 2008 or if you just want to comment from now, is what anecdotally are you seeing for consumers? Are you seeing on choice, competition, and from my perspective, liquidity in the Canadian mortgage market? I think those are things that we need to consider. The BOC forecasts that housing will be a negative impact on growth, on GDP of 0.3 for next year. There may be tail risk on that, if I can use the word tail risk on that side. So I think I'm curious to see as what your early anecdotal evidence or data that you've seen from the housing market changes. If you want to go back to the 15 changes, or just going back from October, what the individual organizations have seen on that front. Thank you.
I'm sorry, is your question specifically around the availability of funding for mortgages? When you mention liquidity, is that
liquidity is availability of funding? Yes.
Yeah. I don't have any particular data around individual institutional liquidity. One of the things that we're tracking both at the bank and at OSFI is the proportion of mortgages that are securitized. So whether or not the originators of mortgages hold the mortgage on their balance sheet and therefore are incented to manage their risk on a long-term basis, versus whether they're sold into the securitization market. As you well know, that was one of the things that, in hindsight, was considered a contributory issue to the U.S. housing crisis. And I think that was the comment earlier that Mr. Albus was related to his question around the difference between mortgage finance companies and banks, and who has access to the different forms of funding or liquidity to fund mortgages on a go-forward basis. But I don't know, Sylvain may have more specific information on that.
I don't have that much to add about the liquidity here or what we've heard on the ground.
Any other comment or feedback in terms of activity in the housing market?
So, Mr. Caron asked a question earlier that suggested potential decline in the housing market or housing construction in Quebec as a result of these decisions. And I know a lot of your work is, I guess, to be concerned about the stability of the financial markets, debt loads, and so on. But do we have anywhere to turn to actually get concrete information on how these decisions do impact the home construction industry, because it's an important economic factor, the home construction industry? And secondly, a question that's been rolling around in my mind is a lot of these decisions relate to the insured mortgage industry. What's the impact of these decisions in the uninsured mortgage industry and the ability of people that have to go to that market in order to finance a home? Anybody get any response to either of those?
I think in terms of the first one, the impact on construction activities, so on and so forth, one thing we had looked at is looking at the impact of different measures, increase in loan to, like the amount of cash down you have to put on the house. So we look at these different measures and look at what resale activity would do around the implementation period, whether they've gone down by how much, and sort of try to get an average. Again, it's difficult to test very specifically for those measures just because we don't have a whole lot of data. So then we do it case by case, sort of case study approach, looking at how, again, resale activity has behaved after the implementation of certain measures, or residential investment, and so on and so forth, so we can get at least a sense of magnitude. And so our estimate is in part informed by those types of analysis.
And what about the insured and non-insured markets?
Well, this is a concern that we have, that that consumers might migrate towards the uninsured market because of those measures. And this is something that we're really keeping a close eye on, definitely.
And have you detected anything to date? You're keeping a close
Not
eye
quite,
on
because, for instance, if you think about co-lending, there's been some stories about co-lending, the fact that you could get a loan from a non-federally regulated institution. The problem with that is we have data from Q2 2016, so we don't have but we know that these are very small. They may be rising, but we don't have the data, so we have a big lag between today and the data. So that's that's why I'm saying that we're keeping an eye on this.
Okay, thank you. Mr. Savard, did you have another question before I cut you off?
Just a quick, to OSFI specifically, more of a comment. I'm actually very happy with the work that's been done with regard to B20 and the superintendent's speech, because I think even going back to Mr. Grewal's comment, my colleague's comment about employment verification, collateral, the way that OSFI put that out, because it was a regional approach. It wasn't a broad-based approach. It was a regional approach in terms of the capital requirements and so forth, and I read through the papers. So I do want to applaud OSFI. Not that the other institutions have done anything different, but on that level there, I was actually happy to see that. Because I think if there is an issue, it may come from that side in terms of employment verification, income verification, collateral verification.
To Mr. Albas, be the last round of questions.
Thank you, Mr. Chair. And I was a little bit disappointed. We have so much brain power here that we wouldn't know that FinTrack is the one that actually is. If you talk to any realtor, they are forced to any transaction where there's over $10,000 in cash paid, they track all of it. So if some members are concerned about that area, perhaps we should ask FinTrack to see what they do with the data. Now, obviously, they're doing it with a lens more towards organized crime or terrorism, but whether or not that information is being referred to the different decision makers, I don't know. So it'd be interesting to find that out. You had an interesting comment, sir, about co-lending. You said specifically when you're not always tracking whether or not someone is being given money so they can put a down payment down as to where that comes from. Am I paraphrasing you correctly?
Just the idea that you would get another loan to finance your down payment.
Oh yeah, okay. Pardon me. Okay. Thank you for saying that. So, my home province, British Columbia, has announced a new policy for first-time home buyers. So, are you tracking when these loans made by the province of British Columbia are made to a first-time home buyer as part of your modeling?
I mean, tracking. I think what we've said on this is, again, there are many features that are keeping house prices up. One worry, a bit like CMHCs that we have, is that by extending those loans, they might feed into higher house prices, and it's not clear that it's really benefiting the people we're trying to get into the market. And these people will just have to make sure that they not get ahead of themselves by. We want the quality of mortgages to.
So when the province decides to put in a foreign buyer's tax, that's technically it gives the power to the City of Vancouver through their charter to be able to charge the foreign national, and then suddenly the Department of Finance through the minister puts down these new rules and could actually perhaps some people thought it caused huge shock to that area. That's not getting ahead of ourselves, but I digress. There has been some discussion, Mr. Chair, around we heard some concerns earlier about consumer debt. I do know, and I have seen many ads that kind of shock me when you see that some people are buying very expensive vehicles on very extended, long-term payment arrangements. But yet, you're concerned about that. But we also have here in Ottawa a government that's adding payroll taxes, carbon taxes, and is making it more difficult for people to be able to get a home where they can actually save money as a form of equity, because we all know our homes are our biggest source of equity. I find it interesting that you're all concerned about consumer debt and the ability to be able to afford a mortgage, but yet, and I guess maybe this comes back to your point, is that you just offer a slice of advice to the person in the chair that makes the decision. I just find it dumbfounding sometimes that we criticize other levels of government for doing things, and we often do them ourselves. Anyway, it's been a very useful conversation, at least to me. I'd like to actually go back, though, to mortgage, we talked a little bit about this earlier, and I said that I was worried about the competitiveness of the industry, particularly what monoline lenders are suggesting. So I'm going to read you this, and I'd like to hear your comments, ma'am, and perhaps anyone else. The federal government backs 100% of the mortgage insurance obligations of CMHC, a unique approach compared to other nations. Our lender risk sharing program would raise the risk for smaller lenders associated with funding mortgages and increase the capital lenders required. Once again, while the banks are sufficiently capitalized to retain loans on their books, smaller lenders are not, and thus would need to increase mortgage lending rates to offset additional risk, thus increasing costs to consumers. Additionally, as monoline lenders who are unable to raise sufficient capital close their doors or merge with others to remain in the market, there will be less competition among lenders, thus increasing rates and costs for borrowers. From a consumer perspective, the net effect again would be that the housing becomes less affordable, not more affordable. In our view, this is unnecessary given Canada's low default rate, circa 0.28%. And the fact that CMHC has more than enough in reserves to cover the outstanding mortgages in the implausible event that every single Canadian defaulted on their mortgage. So, to me, this seems to say that if we continue this, we are going, first of all, you're going to have Canadians that cannot refinance. They're going to be shocked to find out, and you're going to see where the market will become far less competitive and overall prices will go up. Isn't that kind of the opposite of what we want to see? Can you explain to me how, what's the positive side of this policy?
Coming back to your quote, Dan, do you want to give us the source of the quote?
Yes. Again, sir, it is the submission brief from Gary Morris, who's the president of Dominion Lending Centers.
Okay.
And again, it is a third party. However, I do think it's an excellent point that I'd like to know. We're not just making life tougher for consumers, we're also making a market less competitive, which, to be fair, we have a stable system, but stable also does not mean competitive.
I think you're ready to answer.
I might have guessed, actually, that was the source of the quote. I think that pricing, so I think in that particular quote, if I caught the first part right, he's talking about a scenario under lender risk sharing. Is that correct? Okay. So I guess I would start by saying that lender risk sharing is a concept out for consultation right now. And what Mr. Morris is doing is forecasting how a lender risk sharing program would eventually be priced into the market. And I think that's not a given at this stage.
Okay, but is that not, because we did touch upon it earlier in my earlier intervention, that the fact that people are not going to be able to refinance, and that will also cause a similar increase as well.
And I don't agree with that. I mean, I'm happy to have an offline conversation and understand how he's connecting the ability to refinance with the recent policy changes, because I'm missing how he's making that connection. So,
okay.
But with respect to lender risk sharing, which is, I understand, sort of the
okay, maybe we shouldn't go there, but I'd like for us just to elaborate a little bit more on the original conversation, because people are going to be shocked to find out they can't go to their same mortgage broker to get from the same lender a refinance at a particular juncture, and then that will encourage them to go to a traditional lender because they have the capital to be able to meet these rules.
To give you, Ms. Rogers, time to answer the question, because we're going to have to end it at that unless somebody else wants to add a supplementary to Ms. Rogers. Go ahead.
Yeah, I don't think so. Pricing decisions belong to the lender. They don't. We don't set prices. We set capital requirements. And if lenders and insurers choose to pass the capital requirements on to consumers in the form of higher prices, that's a business decision and not a regulatory decision. So I think what Mr. Morris there is, what he's doing is he's making a series of assumptions about how risk sharing or business models or other business decisions are going to change as a result of these decisions, and forecasting price increases and then forecasting bad things as a result of those price increases. I would say lender risk sharing, as it's contemplated in the current consultation paper, talks about moving risk between the mortgage insurer and the lender. Logically, the capital requirements would then move down for the insurer and up for the lender. Whether or not they would all then move to the consumer, I would be surprised if it gets fully downloaded to the consumer. The insurer would hold less capital, the lender would hold more capital, the insurance premium would be reflected downward to consumers, the interest rate or the pricing to lender may be reflected upwards. We don't know that, though. That's the purpose of the consultation, is to think these things through.
To our original discussion about people that own property over $1 million or who are refinancing that wouldn't qualify under the new rules, they will have to, because of these the increased costs, will have to go to a traditional lender.
Dan, we're going to.
Well, I'm just trying to get. Because I ended up going off topic.
I know.
Thank you.
Does any of the other witnesses want to add anything? All right. With that, we'll thank the representatives from the Bank of Canada Mortgage and Housing Corporation, and OSFI. Thank you for your testimony and your answering of questions before the committee. Before we suspend for the next 4 witnesses to come up, there's been kind of some off-the-side discussions here, and I wonder if this will fit with people's approval. There is a citizen initiative for a solidarity vigil on Parliament Hill in solidarity with the Muslim communities of Quebec and Canada over the people that were killed at the mosque in Quebec. That is a 2-hour vigil. I know there is some members would like to attend that. What I'd suggest, if we could do it this way, we do have a number of witnesses. We're supposed to meet until 7:30. Would it be acceptable, once we hear the testimony of the witnesses, to have a moment's silence in solidarity with those that are on Parliament Hill, rather than disrupt the witnesses and close the committee down, because it is a 2-hour vigil? Would that be acceptable?
We would support that, Mr. Chair.
Is everyone okay with that? That's what we'll do. So following the witnesses' presentation in the next round, then we'll have a moment's silence in solidarity with the vigil that's on Parliament Hill. Okay, we'll suspend. Thank you. For the second session on study of the Canadian real estate market and home ownership. And to start with our witnesses, we'll start with the Canadian Bankers Association, Mr. Shapera, who's with the CBA, and Mr. Hogg, who's with the Royal Bank of Canada. Who's going? Mr. Shapera? And do I have your name right?
Close.
Okay. If I'm close, that's pretty good.
Thank you very much, Mr. Easter, and good evening, everyone. We would like to thank the committee for the opportunity to contribute to its study on the Canadian real estate market and home ownership. The Canadian Bankers Association works on behalf of 59 domestic banks, foreign bank subsidiaries, and foreign bank branches in Canada and their 280,000 employees. Accompanying me today is Robert Hogg, who is Senior Economist at the Royal Bank of Canada. As you may know, Robert is one of the leading experts on the Canadian housing market. At the outset, I should note, as has been widely discussed even today, that there is not one single housing market in this country. Rather, there are several different markets across the country impacted by a range of supply and demand factors that affect housing prices. One factor common to all these markets are the historically low interest rates. Of course, there are other more local factors such as the city or region's attractiveness as a place to live and work, land use and zoning restrictions, the relative availability of certain housing types, and population and job growth. For instance, Vancouver and Toronto have seen growing housing prices over the past few years. Meanwhile, oil-producing regions have seen either a decline or negligible housing price growth. And in the rest of the country, we have seen housing prices grow more moderately. Accordingly, when developing housing policies and regulations, it's important to account for the variability that characterizes these housing markets. As the committee is well aware, the federal government has introduced a number of changes to Canada's mortgage and housing markets over the last several years. For example, on uninsured mortgages, the government has reduced the maximum amortization period, increased minimum down payments, and implemented more rigorous stress testing. We understand and support the federal government's objective of maintaining stability in the Canadian real estate market in all parts of the country. Given that the impact of some of these changes has yet to fully materialize, we believe it would be prudent to wait and assess the impact of recent changes before contemplating any additional new measures. Canadian banks have a strong track record of careful, prudent mortgage lending. Moreover, the vast majority of Canadians are responsible borrowers who use credit wisely. This is evidenced by the performance of the bank's mortgage portfolios before, during, and after the global financial crisis. The CBA closely monitors mortgages and arrears statistics. A mortgage is classified as being in arrears when the borrower is 90 days behind on their payments. Currently, the Canadian mortgages and arrears rate sits at 0.28%, which is close to the low rate prior to the global financial crisis. The rate in Canada, during the global financial crisis, the rate in Canada peaked at 0.45%. By way of comparison, the arrears rate in the United States during the crisis peaked above 5%, more than 11 times the Canadian rate. Since the 1990s, the rate in Canada has never climbed greater than 0.65%. That's over 2 decades of stability in times of both high and low unemployment and fluctuating interest rates and Canadian dollar. Canadian banks have a solid mortgage lending record rooted in high underwriting standards, which have only strengthened since the financial crisis. Whether a mortgage is insured or uninsured, banks apply the same prudent application and underwriting processes. Banks are rigorous in the origination of new mortgages, including the verification of a borrower's identity, employment status, income, and credit history. Furthermore, in making a decision to extend the mortgage, banks take as paramount a borrower's demonstrated willingness and capacity to make debt payments on a timely basis. Canada's banks also undertake rigorous stress testing to ensure that Canadians can pay off their mortgages during changing economic conditions. This includes requiring potential borrowers to qualify at higher interest rates to ensure that they are able to make future payments under higher interest rate conditions. It is also important to note that the Office of the Superintendent of Financial Institutions plays an important supervisory function over bank underwriting practices. In closing, banks take seriously the role they play along with governments, regulators, and Canadian borrowers in ensuring the Canadian mortgage and housing market remain stable and sound. I would like to thank the committee again for this opportunity to provide the banking industry's perspective on Canada's real estate markets. We will be happy to answer your questions.
Thanks very much, Mr. Shapiro. Turning to the Canadian Housing and Renewal Association, Mr. Morrison, Executive Director. Welcome, Jeff.
Well, thank you, Mr. Chair, for the opportunity to speak to the committee today to discuss home ownership in Canada. As many of you may know, the Canadian Housing and Renewal Association represents the interests of the social, affordable, and non-profit housing sector in Canada. When most of us think of home affordability and ownership, we of course tend to think of the private market. Many of us have followed this traditional path towards home ownership, which includes, of course, entry into the rental market, saving for that first down payment, taking on a mortgage, refinancing, and for the lucky of us, maybe paying off the mortgage. And although this path has been made more difficult with housing prices that have generally exceeded inflation over the past few years, we know that based on CMHC's fourth quarter 2016 report, that MLS sales in 2016 will exceed 2015, demonstrating that this traditional path to home ownership remains viable. Mais cependant, je demanderai au comité.
However, I would like the committee to keep in mind the home ownership path that's alternative, non-traditional, where the social housing sectors, the not-for-profit sectors, and social enterprise and social businesses would play an important role. As we all know, the traditional path to home ownership is simply not available to a great number of Canadians. Even by saving for a first down payment, most Canadians are unable to pay for a house.
Encourage and lead to home ownership. The Habitat for Humanity model is one example where sweat equity acts as a form of down payment. There are also innovative social housing models where the housing organization or provider provides financial literacy programs, as well as matching incentives for families who save and build their assets in escrow. This pool of capital can then be used for households for such investments as a down payment. There's also models such as the Attainable Homes Calgary Corps, which is a city-owned corporation that enables first-time buyers to buy with a down payment of as little as $2,000. This corporation works with builders, developers, lenders, and others in order to bring down the upfront costs of ownership to deliver entry-level homes. As another example, there's the Trillium Housing Social Enterprise model, or the Options for Homes model, both in Toronto, which are nonprofit housing organizations that employ a pay-it-forward model, where the nonprofit provider co-invests with the homeowner by taking out a second mortgage on a property, and costs are kept down by partnerships with local suppliers, and no payments on the second mortgage are required until the unit is sold or rented out, and the price appreciation covers the difference. In Toronto, the Options for Homes model has helped about 3,500 households enter the home ownership market when they otherwise wouldn't have been able to. Alors, que peut faire?
So what can the federal government do to both support and promote some of the non-traditional paths to home ownership and thus reduce inequalities across Canada? Generally speaking, we feel that the current national strategy for home ownership should include more focus on very vulnerable populations across Canada in order to do more to support equality. In our brief, we have put forward 24 recommendations on the manner in which the federal government could do this, and I will be very happy to share an example from my brief. But speaking to the committee's mandate, what specific strategies might strengthen social housing and home ownership? We have 3 suggestions.
Mr. Trudeau's mandate letter directive to make surplus federal lands available for social and nonprofit housing purposes. Enactment of such a policy would cover a significant capital expenditures for social housing providers, and CHRA has recommended vastly expanding the already existing surplus federal real property for homeless initiative to enact this policy. Second, introduce a social housing sector transformation initiative that would provide social housing providers with relatively small amounts of capital to introduce innovative programs such as the Trillium Housing or Attainable Homes Calgary model. This is especially important in light of the end of operating agreements, which thousands of social housing providers are already facing. And then lastly, there is a need, and in fact we saw this in your first round of questions, there is a need for better research and collection of domestic and international best practices on the interconnections within the housing spectrum. By researching and disseminating information on housing policies and models that work, we can facilitate the move to ownership. In our submission to the National Housing Strategy, CHRA has recommended the creation of what we call a housing research hub, similar to the Canadian Institute of Health Research, that would, among other things, conduct and disseminate world-class research on housing policies. Mr. Chair, the road to home ownership is traversed in a lot of different ways. If we want housing policy that meets the needs of all Canadians and not just those with the greatest incomes, we need to think holistically and creatively to ensure that ownership is a dream that all Canadians can access. And the social and nonprofit housing sector is here to help make that happen. Merci, Monsieur le Président. Thank you, Mr. Chair.
Thank you, Jeff. Canadian Credit Union Association, Mr. Martin and Mr. White. They'll get the mic there.
Got it, thanks. Bonsoir.
Good evening. The Canadian Credit Union Association welcomes the opportunity to brief you in relation to the Canadian real estate market. Our comments focus on recent regulatory developments and the government's proposed mortgage insurance risk-sharing framework. Our message to this committee is twofold.
Much like the CBA, for a pause and review the impact of the myriad regulatory measures that have targeted the housing finance market and mortgage insurance over these last number of years has created a situation where consumers and associations such as ours need to take a step back and really understand what the objectives of the government, and particularly the impact that it has taken on first-time home buyers, rural and remote regions, really looks like. And it's not clear to us that the government has allowed themselves to have that opportunity. CCUA does not support the government proposal to introduce a mortgage insurance risk-sharing framework for lenders. In our view, there is no strong empirical justification for introducing the framework and the models that will likely exacerbate mortgage price and availability issues for first-time homebuyers for Canadians living in rural and remote regions. Since the financial crisis, the federal government has announced at least 15 housing finance-related measures aimed at addressing household debt vulnerabilities, housing price pressures, and managing government exposure. These cascading measures have reduced a secular decline in the rate of mortgage origination in Canada since 2008, with the rate falling from a peak of around 13% to its current value of around 6%. The recent changes to high and low ratio insured mortgage underwriting requirements are still working their way through the market, and observers, including ourselves, expect them to exert a significantly downward impact on market activity. Selon une enquête réalisée auprès de
The TCO survey of credit unions indicates that if the rules announced in late 2016 had been in place in January 1st, 2016, high-ratio mortgage volumes, on average, could have been down by nearly 37% last year.
BC's Lower Mainland, with potential denials of high-ratio mortgage applications ranging from 35 to 69.5%, depending upon the credit union. The second largest projected impact would be in the GTA, with potential denials of high-ratio mortgage applications ranging from 22 to 50.7%. In Alberta, we saw ranges from 13 to 46.4%. Based on 2016 approvals, our survey suggested that first-time homebuyer approvals could be down nearly 20%. We also expect significant declines in rural and remote Canada. Tougher qualifying requirements for low-ratio transactional mortgage insurance would have made the product unavailable for nearly 50% of qualified borrowers based on our 2016 data. Low-ratio transactional insurance is often used by credit unions in rural and remote areas to give the lender greater protection in the event the home cannot be easily sold in illiquid markets. It appears that mortgage credit in these areas will be less available or come at a higher cost. We stress that these are estimated impacts based on credit union 2016 approvals. Of course, people may choose to delay buying, buy a smaller home, and the bank of mom and dad may contribute further to a down payment. That said, we believe that when the spring buying season commences, these measures will have a significant impact on the market, whether it be urban, rural, high or low growth. Tightening mortgage insurance eligibility requirements are also impacting the competitive balance in the financial sector. New eligibility requirements have reduced the pool of mortgages eligible for insurance. This hits the mortgage funding side because these insured mortgages can be securitized. This is a concern for credit unions that have been involved in securitizing mortgages to help fund growth across the country. This funding channel has now been significantly curtailed, and this forces credit unions to fall back on deposits and retain earnings to fund growth. Meanwhile, large banks are able to attract funding through other channels not available to cooperatively owned credit unions. Inadvertently, these new rules have tilted the competitive balance towards the already dominant banks. In our ongoing policy dialogue with the Department of Finance, and congratulations on your appointment as the new Parliamentary Secretary, we have recommended that it is time for the federal government to pause and review the impact previous measures are having on the market. We reiterate that recommendation today. Officials must consider whether, from a policy perspective, the impacts on first-time homebuyers, rural and remote regions, and the competitive balance in the financial sector are necessary, desirable, and well-calibrated. CCUA would welcome such an ongoing dialogue.
In late October 2016, the Department of Finance announced it would be consulting Canadians and stakeholders in relation to implementing a risk-sharing mortgage insurance framework. The proposals envision a significant departure from Canada's current practices.
Transfer mortgage risk to mortgage insurers and indirectly to the federal government's guarantee of mortgage insurer obligations. Borrowers pay premiums to obtain this blanket coverage, and lenders can also choose to transfer risks on other mortgages that they elect to insure. Lenders pay premiums on those mortgages. It should also be noted that these lenders can insure claims denied if they do not meet underwriting standards set by mortgage insurers and the government. The risk-sharing proposals would see lenders accept more losses associated with defaulting mortgages and make more of the capital available to cover these losses. Lenders would be exposed to loan losses in both a normal loss situation as well as in extreme loss events. Policymakers accept that this prospect of losses will further discipline lender risk management practices and result in a tightening of lending criteria. CCUA acknowledges the federal government's theoretical rationale behind the risk-sharing proposals. However, we don't believe that a strong empirical argument has been made to date for these proposals. To elaborate, the logic underlying the government's proposal suggests that incentives exist to promote risky lending because lenders can use mortgage insurance to offload the risk associated with mortgage lending. However, we have not been presented with evidence that illustrates this happening. In fact, CMHC numbers suggest that arrears on insured mortgages are incredibly low. Between 2010 and 2015, the 90-day arrears rate on insured mortgages have averaged 0.36%. As of September 30, 2016, arrears on mortgages in the CMHC's National Housing Act Mortgage-Backed Securities Program sat at 0.2% for federally regulated institutions and 0.13% for provincial institutions, including credit unions. These numbers hardly suggest lax insured mortgage underwriting practices in Canada. While this lack of supporting data should give the federal government pause before implementing the risk-sharing proposals, there are other issues that should also be considered. These remarks that I have just given have noted concerns about mortgage credit for first-time homebuyers and those living in rural and remote regions. In our view, the introduction of risk-sharing will exacerbate these challenges already faced by those consumers. Lenders will respond by increased capital provisioning to offset anticipated losses, reduce lending as a result, and increase the cost of credit to demographics and regions perceived to be higher risk, yet also very much in need of mortgage credit. It is also possible that insurers will increasingly calibrate premiums to assessment of local markets and the concentration risk of the lender that the insurer now has exposure to. This could further increase mortgage costs in rural remote regions and negatively impact small local lenders.
Of course, these developments are of particular concern to credit unions that often service rural and remote regions, and with a membership that will face these practical consequences.
Votre attention, nous serons heureux de répondre à vos questions.
Pleased to respond to your questions.
Genworth, Canada, Mr. Levings, and Mr. McDonald.
Good evening. Thank you, Mr. Chair. Genworth Canada is this country's largest private sector mortgage insurer with about 30% market share and CMHC's largest competitor. The insurance we provide reimburses lenders for their losses when homebuyers default. Mortgage insurance is mandatory for home buyers who put down less than 20%. Thus, we primarily serve first-time home buyers. With insurers taking default risk, lenders are able to offer first-time buyers competitive interest rates and have confidence to do so across Canada and throughout economic cycles. We're housing risk aggregators with specialized expertise. We're well-capitalized, tightly regulated, and deeply experienced to properly manage mortgage-related risks. Regarding the topic of mortgage rule changes, I will speak to two key points tonight. First, the government has made numerous changes in the insured mortgage segment over the past couple of years, some with impacts yet to be felt. To avoid a potential tipping point, it's critical that we take a pause and assess the cumulative impact prior to considering any additional changes, including the current risk-sharing proposal. Secondly, the changes to date have largely targeted aspiring first-time home buyers, making it harder for them to gain a foothold in the housing market today. Home ownership and the opportunity to build equity through the forced savings mechanism of a mortgage payment is an important cornerstone of the financial plan for many young families. We believe they aren't the problem, and that further targeting of this segment is not the best solution. Insured first-timers are the most tightly regulated, rigorously underwritten borrowers in the market today. These buyers reside in all regions across Canada, range in age from 25 to 40, and typically demonstrate stable employment with average household incomes of $80,000 to $100,000. They buy homes they can afford, often below market averages, especially in Toronto and Vancouver. Their credit scores reflect fiscally prudent, responsible borrowers averaging a score of 752 last year. Canada's mortgage finance system is a proven model. The rest of the world views our mortgage insurance structure as a best practice and key contributor to our mortgage finance stability. During the global financial crisis, U.S. delinquencies rose above 5%. By contrast, Genworth's worst vintage year to date is 2007, which peaked in 2009 at 0.95%. Our submission highlights nearly 24 federal interventions since 2008, primarily targeting the insured market and first-time buyers. While many of these changes have contributed to the overall strength of our mortgage finance system, some may have gone too far. The most recent changes last October, for example, are significant, the impacts of which are yet to be fully observed. I can't stress enough, it's going to take time before we know their total cumulative effect on the market. We believe implementing any more changes could tip the market too far, creating the kinds of housing challenges these measures seek to prevent, hurting new buyers, existing homeowners, and the broader economy in the process. Let me address the last two changes specifically. In December 2015, the government increased minimum down payments on homes selling over $500,000. While targeting the strong Toronto and Vancouver markets, these changes had an impact on other markets too. Calgary, in particular, was hit quite hard, with approximately 12% of insured buyers affected by the change. As you know, this market was already under pressure and didn't need any additional cooling. In fact, only 13% of the Toronto and Vancouver buyers were making down payments small enough to be impacted, despite the much higher average price in these regions. Given how little the first-time buyer participates in these two cities, it's not surprising that despite these and other changes to date, significant home price appreciation in Toronto and Vancouver continued. National solutions are perhaps ill-suited to address local market challenges. Recently, Vancouver's market has started to slow. However, it appears to be driven by a local solution to a local challenge, specifically foreign buyers. Last October brought more changes, including an interest rate stress test for insured buyers. While we support the concept of a stress test, we believe the target was set too high. Let me be clear, this was a significant change. Under this new test, approximately 1/3 of the first-time buyers we approved in 2016 would now be offside. These buyers face stark choices: buy a less expensive home, perhaps a condo or further from work, ask their parents for more money, delay their purchase to save for a larger down payment, or consider a bundled loan from a private lender. It's this option that should concern us most, pushing first-time buyers into the private lending space, a segment that continues to grow as mortgage insurance rules tighten. This segment represents a higher cost option with limited transparency and regulatory oversight. To conclude, in 2010, the insured market represented approximately 40% of our annual originations. With the cumulative changes, it's expected to drop to around 20% this year. Home prices and related mortgage debt are growing the fastest in segments of the market that are not accessible to first-time buyers. Yet even though they're not driving the problem, they're the ones absorbing all the consequences, making it even harder for them to access responsible home ownership. The big question we need to ask is, what's the cumulative impact of all these changes for home prices, demand, first-time buyers, and the growing unregulated sector? What should the government do? In our view, take a pause. Study the impact of all the changes made to date before considering any more. Secondly, if after that study it is deemed that more change should be considered, modify the stress test to better reflect future rate expectations. 3, given the number of potentially damaging consequences, do not proceed with a risk-sharing model. And finally, continue to work closely with other levels of government to study and address individual housing markets at the regional level. Thank you for your attention to these issues, and we're happy to take any questions you might have.
Thank you, Stuart, and thank you all the witnesses for your presentations. Before we go to Mr. Graywall in the first rounds of questions, as I indicated earlier, we will ask the room to take a moment's silence in solidarity with the vigil outside for the Muslim communities of Quebec and Canada who tragically lost somebody. So good. Thank you all. Turning to Mr. Graywall, first round, 7 minutes.
Thank you, Mr. Chair, and thank you to witnesses for coming today. I heard the word pause a bunch of times, that the government should pause, see the impact of the regulations. So thank you for making that so abundantly clear. I couldn't agree with you more that we should pause, because I think we're at a sensitive place in the housing market, that there's regulation, which I think protects Canadians, but we also don't want to over-regulate this market, which will have negative economic consequences. I just wanted to get some more information on the default rate. So a few of you commented on the default rate, that it's historically low. How does it compare to other countries? And if you have that data, or if you don't, it's okay.
Excuse me. The CBA does collect data on mortgages in arrears. The mortgage in arrears rate right now is 0.28%, and what that means is about 1 in 350 mortgages are in arrears. You compare that to the financial crisis, that number went up to about 0.45% at around 2008 in Canada. In comparison, in the United States, that figure went up to above 5%, so 11 times that figure, which I think demonstrates the differences between the Canadian and U.S. markets. If you go back further, the mortgage and arrears rate has gone no higher than 0.65% nationally. Now, there are some regional variations, but nationally, that figure has been no higher than 0.65%.
Is there any insight into the economic slowdown in Alberta and default rates there in that regional market in Calgary?
Yeah, so we do collect that data. We've seen a slight uptick in mortgage in arrears, but it's manageable. And then we've noticed the same thing on the consumer delinquency side, that we've seen an uptick there. But because the books of the Canadian banks are just so broad, so diverse, they can diversify that risk to say other lower lower regions with lower mortgages and arrears like Ontario and BC.
So the arrears number is one statistic, and then I'm assuming there's another statistic for mortgage defaults, like actual power of sales. Has that increased in the last couple of years?
We don't collect those figures, but I don't imagine them being particularly high, given that the mortgages and arrears are just so low. Because the mortgages and arrears are the mortgages that would then be in default, but quite often we would, in the instance of, say, insured mortgages, which have the lowest amount of equity, the banks and other lenders would work with mortgage insurers to help keep them in their house.
Yes, sir.
Yeah, I can speak to on the actual foreclosure side. Given we deal with the first-time home buyer, and of course that does represent small down payments and naturally the highest risk segment of the market, we've actually seen an overall decline in the number of foreclosures over the last number of years. Now that's obviously a function of both the strength of the economy and the housing market, and we know from experience that unemployment is the key driver of mortgage default and claim or foreclosure. And obviously with the economy doing well as it has been, that has helped. But even when you go back in time to, say, the 07-08 timeframe, our delinquencies were only marginally higher than what you heard from Alex as far as the overall CBA delinquency rate. And it actually improved over that period of time. And that is a testament to a number of the changes that the government made that, as I referenced earlier, were positive and took out some of the marginal risk in the market. We're at a danger now, as you alluded to, of tipping it too far by going any further. But those changes that were made earlier in the years of 07, 08, 9, 10, 12 were good changes and have helped to improve the overall performance of mortgages in this country, including the highest risk mortgages or low down payment mortgages.
Thank you. In terms of application tracking, has there been an increase in the amount of Canadians applying for mortgages on a year-over-year basis? It's a broad-based question, so anybody can jump in.
I can certainly again speak to from a first-time home buyer point of view, which is the area we see. There actually has not been an increase. That market has been under pressure throughout most of 2015 and increasingly so into 2016. Again, you had a number of changes that were made. You've also had the ongoing affordability pressure that has really driven more and more first-time buyers out of the market. The most recent round of changes, just another blow to that situation. But for sure, the number of first-time buyers in 2016 was smaller than the number in 2015. We expect that to drop this year by another 15 to 25% based on the changes that were made.
It's a close figure, correlation. You mentioned applications. We'll look at mortgage credit growth. In 2008, mortgage credit growth was about 14% per year. That has declined to about 6%. So mortgage credit growth has not been has slowed down in terms of its growth. In addition to that, the nature of that growth has changed in terms of composition. In 2008, 2009, I'd say about 4 out of 10 mortgages were insured mortgages. That has declined to about 2 out of 10 right now. So the composition of, so not only has mortgage credit growth declined, the composition of that credit growth has changed as well.
An increase or a decrease in the applications that are approved?
That
are approved. So there's one is the statistic of how many people are applying for a mortgage. The second statistic would be what are the increase, decrease on approval numbers year over year?
For sure. Sorry, go ahead.
Well, I can speak to a bit of it. We don't have the exact numbers, but we did some estimates based on 2016 approvals. What we did is we modeled what the impact of the October 2016 changes would have been on our book, and it's a decline by about 37% nationally in the number of approved high-ratio mortgages. That's what we're estimating, and it depends on which region you are. It can be higher in the Lower Mainland, BC, of course in Toronto, and somewhat in Alberta, higher than that.
And to your question, as far as actual approvals in 2016, again, down over 2015, the down payment rule change being the driver of that.
Perfect. Now, my last question is, you mentioned the unregulated sector and how that could be a potential concern. Can you comment a little bit more on that and how you think that that could be a concern to the overall market?
This is anecdotal, but what we've observed is that as the mortgage insurance rules have tightened, we're seeing more and more borrowers being forced into what we would call sort of the private banking space, not necessarily unregulated, because there are the MFCs that are in a way regulated, but really into private banking. What that means is that they're obtaining a first mortgage up to 80% loan to value that isn't insured, which doesn't require then the 25-year AM or the interest rate stress test, and they're going to a private lender to obtain another 10 or 15% for the remaining portion of their loan. That will be at a higher cost, but it's still reasonable to the consumer because it's the only way they can now afford a home. Our view is those borrowers represent good quality borrowers that we were insuring all day long before the change. They're now being forced into this more expensive option simply because the interest rate stress test is very severe, and in our view, too severe.
Okay, my last question, sorry, just 30 seconds.
Okay.
Thanks, Ron, you're a gentleman. The last question is there data on how many second and third mortgages are on a property? So if like RBC or TD or Genworth had the first mortgage on the property, but then the homeowner has a second mortgage on the property, and I would conventionally assume those are more riskier mortgages to be in. Is there data that's being collected on that?
I certainly have not seen that data. That data is not available publicly. So the answer is no right now.
Like through like PPSA searches, right? So like the bank would know if somebody took out another security on their security.
Yes, probably. But I'm not sure if I've seen that aggregated. No one, I don't know if anyone has really taken the time to do that and taken a sort of economy-wide, financial market-wide perspective of that.
Robert to do it.
The credit bureaus do report when there is a mortgage, so you could, to Alex's point, look through that, but there's been no aggregation of that data at this point, to my knowledge, either.
Sounds good. Thank you, gentlemen. I really appreciate it. Thank you, Ron.
Thanks, Mr. Graywell. We'll deduct that time off of Ms. O'Connell. We'll move to Mr. McColman, who actually proposed the motion that we're examining here tonight during his former time as a member of this committee. So, Mr. McColman, you have 10.5 minutes like Mr. Graywell has.
I was going to say, do I get his extra time? To our representatives from Genworth, what's your overall view of the CMHC's mortgage portfolio, mortgage risk portfolio?
I would say that their portfolio is of a high quality nature, much like ourselves, and the reason for that is that the regulator has been very active in this space for some time now, and more recently, a couple of years back, introduced something called B21, which has really helped to converge all levels of mortgage insurance underwriting to the same standard. In addition to B20, which was rolled out for lenders, it's really raised the bar on mortgage underwriting as a whole. So we can't really say that there's a lot of material differences between the portfolios of the three mortgage insurers.
It seems to me the government wants to offload some risk. So it seems to me that what is perhaps underlying some of their portfolio is the fact that maybe we have too much risk applied to what could happen in a market disaster to the taxpayer. I'll just make that as a comment. Now, Mr. Hogue, you were introduced by your colleague as being an expert in the housing field. When you look at affordability, when you look at first-time home buyers, when you look at the profile, if it was a pie chart like you see on the gas pumps, of what the cost of a new home is in terms of builder input, materials, labor, land, development charges, all of the, or not all the rest of it. I've made my own pie chart. Land, labor, materials, financing costs, and profit. The last one being government-imposed regulation, fees, and taxation. What is the percentage of government fees, regulation, taxes, and imposed fees?
depends on which jurisdiction you're
Average.
talking about.
Average jurisdiction.
I've seen numbers in probably 15 to 20%.
15 to 20%. I've been told by the home building industry it's more like 25 to 40%, depending on the jurisdiction. So when we talk about people wanting to get first time into the market, first-time home buyers insured, and they come to you, and the price of a house in my jurisdiction, Brantford, Ontario, is being influenced by the GTA prices, which are now filtering down through Hamilton, through Oakville, Burlington, Hamilton, Ancaster, Brantford, right? Hour away from Toronto. You see the huge spike in prices. Every spike in price, would you agree, as a panel, just knocks a whole lot of people out of the market? Is that correct? Is that correct?
That is absolutely correct. That's one of the issues that we've been facing all this time, is that affordability is eroding as prices get knocked up, starting in the cities, whether it's Toronto or Vancouver, and then effectively filtering out through neighboring suburbs as people drive further and further to be able to find something that they can afford.
And so what governments do, all three layers, or more the upper two tiers, is they take hot markets like Vancouver and Toronto, and they say, we have a problem. It's too hot. We've got to cool it down. And so they bring in the rules and regulations that you want them to take a pause on doing any more on, correct? But it's specific to those markets. So what's your view in terms of how government policy should react to hot markets like that and not affect the people who are building affordable housing right across my province of Ontario, 4, 5, 6 houses a year, and they're building in their own local communities? They're dealing with a whole different market than those, but governments put a one-size-fits-all regulation in place. Anyone want to jump on that one and make a comment?
Well, I would agree that that is the issue that we are facing, is the measures introduced are trying to target those two cities, but they're national by nature. And the impact is felt oftentimes elsewhere and not in those cities, because they're targeting first-time insured buyers who are very modest players in those two big cities that you're talking about. Our view is that there really is a need to think about leveling the qualifying criteria between the insured and the uninsured space. The uninsured space being where today a borrower can get 40% larger mortgage with the same income than an insured borrower can get with the same income.
Sure.
And that's part of the problem.
Okay.
Thank you. I mean, you heard it in your last panel, and I think the reflection of a lot of the members was, you've got a problem, you've got a challenge in two cities, but you've imposed this blanket policy or pan-Canadian policy. And I think what you're hearing from this panel is, we understand, and no one is suggesting that the government hasn't acted prudently post-2008, but there comes a point where they need to engage stakeholders more. And when the provisions were introduced last fall, it caught everybody off in the marketplace. And when we look at the credit union system, for example, we had credit unions across Canada that were implementing policies that had been sanctioned by FINA, had been sanctioned by the Bank of Canada, but now have come back to bite them, and they had had no warning. So understand that you need to address the Toronto market and the Vancouver market, but there has to be a way that you can calibrate your policies, or that are specifically targeted, much like you do for EI, for example. You have targeted regions and you have targeted segmented markets across Canada. Having worked at HRDC on the political side, it's a really challenging policy to implement, but it does work, and it takes a lot, that's where the government has an opportunity. The last point would be
Can I just interrupt you?
Yeah,
I'm
please.
sorry. I'm going to cut you off.
Sure.
I got a certain period of time, and I've got a lot to cover here with you guys. Were you consulted on the changes last fall?
No.
Were you consulted? No. Were you consulted? Were you consulted? No. So no one in your realm was consulted by the Minister of Finance bringing in those changes. Am I correct across the board? Thank you for that. The realtors weren't consulted, by the way. The New Home Builders Association, the Canadian New Home Builders Association, was not consulted. So we're talking about internal government bureaucratic decisions that are flowing up from the bureaucrats who in their wisdom, they seem to see how they need to cool the market. They tell the minister through the deputy minister, oh, here's something we should do to cool these markets. You think it's going to work? You think it's going to work in Brantford? You think it's going to work in Simcoe, Ontario? You think it's going to work somewhere in Calgary when the market's going down the tubes. No, it's not. It's only going to harm the market. I like your idea of pause. I'd rather see pause and 3 steps backwards, frankly, and get this market healthy in most of the country and out of the hot market. So those are my personal comments. But
One more question, and then you will equal Mr. Grewal in time.
I'll actually stop there. Thank you.
Okay. All right, Mr. Carroll.
Merci beaucoup. En fait, pour...
Thank you very much. In order to follow up on this question, and I'm very curious because I'm not familiar with the usual practices in these decisions on the part of the government or CMHC, the question was, were you consulted with regard to the recent changes made? I think there were 10 changes that have been made since 2006 overall to restrict accessibility. Is it a standard practice to consult you with regard to these changes? Were you consulted with regard to the changes made in 2011, 12, 13, 14?
CMHC and I think the finance officials call sandbox measures. They tend not to consult when they implement them, and they usually play with the parameters around eligibility and things that are already in place. When they do move to actually sort of change the structure of the regulatory regime, whether it's through OSFI, then they tend to consult on their guidelines, and there's time there. But the sandbox measures all the way along have tended to surprise us.
I would say, as federally regulated financial institutions, we speak to stakeholders, government stakeholders often, Department of Finance, CMHC, OSFI, as regulated entities, let them know what's going on in the marketplace. But to Rob's point, they don't present us with, hey, this is what we're doing, what do you think? But we do have regular consultations and dialogue with federal stakeholders, as we are federally regulated financial institutions.
Mais à ça, je vais poser la question, vous l'êtes encore, vous avez...
But that's my question. You still have these meetings regularly. This relationship is still there. Whether or not decisions are made by the Minister of Finance, whether they're taken or not by him, this is the kind of consultation you have.
The federally regulated financial institutions such as banks provide them with our views. It's really up to the government to determine how to utilize those views.
I would just add that we certainly consult regularly with the Department of Finance and do, to Alex's point, provide a lot of data. Because we're specifically in the high ratio space, we often do get a sense from them on areas that they're exploring and can guide on potential impacts from that. This example in October last year was one where we were absolutely caught off guard in terms of the interest rate stress test and the elimination of the refinance from the low ratio product.
La question que j'aurais, c'est des changements qui sont quand même...
My question is as follows. The large changes, let's say the lower repayment period, which was a maximum of 40 years, in 2006 is now 25 years, so that's gone gradually, but the maximal period has dropped by 15 years, and that's quite a good deal, and that's not even over a decade for servicing the debt. For these changes that have had a real impact on your business, were you consulted about it all before this got underway? Or are you simply being asked now what the impact of these changes has been on your business after the fact?
Changes through the years of 2009, 10, 11, 12, 13 were items that we absolutely supported and were in discussion once again with the government along the way. We were certainly not told we're going to do this, but there was discussion around we're evaluating potential changes along the lines of. And again, those are changes that have contributed to the overall strength of the market today. I think our point now is that the most recent change actually generated an incredible amount of confusion in the market, has had probably the most impact of any of the changes to date, and was something that caught the industry pretty much off guard.
So would I go too far by saying that for all these changes that we have witnessed since 2006, this is really the first time that you're not in support of the announcement that was made?
That is correct. We believe it went too far.
Okay. Another question, une autre question que j'aurais en fait, c'est que...
Another question for you. In a number of cases, I hear say that we haven't the information, And I remember that one of your colleagues from the CIBC, Mr. Tall, had indeed spoken up about this, saying there wasn't enough available good information about the real estate and housing market across the country. I'd like to know whether this is being redressed now and what the needs for information are at present. So, if changes of this nature are brought in without proper data, how much can we count on getting the right results? Yeah, there are still some big holes in the publicly available data set. Efforts have been made to solve this, and we certainly must thank the CMHC for having made more data available to the public regarding its portfolio, which tends to be quite representative of the market overall. But yes, there are a lot of bits of data we could do better with. Well, you're speaking to an economist, so to my mind, the more data we have, the better our analyses will be. You're right. Well, the reason I'm putting this question is because I asked this of the prior panel members. There was a decision made by the federal government changing the property homeowner access, home buyer plan requirements, and also there is a sales tax on new housing imposed in some of the provinces. Prices have dropped due to one of these measures or to the other or to both? Is there any way to tell the difference between the impact of these various measures that have been instituted? It's very difficult to tell right now. You've mentioned some of the measures. There have been others that have brought in as well. Regulations, regulating the real estate sector overall. A number of factors really have had an effect on the current situation. So prices have dropped in Vancouver. Not much, but slight. Well, at least they are stable now. They're flatlining, yes. Resale prices are down, but not much of a clear effect in Toronto yet, nor in Montreal. No, not yet. But, it's all very soon. As my colleagues have mentioned here, it's still very early to try to judge the effects of the measures that have been brought in. So is it too soon to try to conclude that the stabilizing of the prices, the flatlining of the prices in Vancouver is more due to the province's decisions than to the finance department's decisions? Well, up to now, given that the province's decision was taken a while ago, I think that's probably the measure that's had the most impact so far. That's in theory, at least.
Something as well.
Well, I think just on the general question of the need for better and more data, of more and better research within the housing spectrum, I think your questions really underscore the need for a dedicated body, a dedicated forum whereby greater demands for data, for research can be conducted. And as we move very shortly into a new national housing strategy framework, which Minister Duclos will be shortly announcing, there will likely be even greater needs for that data, for which CMHC at present does not have the capacity. Let's have a dedicated forum in which we can do that.
Mr. Martin?
Yeah, just one follow-up on that. We are aware that CMHC is actually trying to expand its data that it's going to make public, but also what it collects. So the credit union as a system is beginning work with them to be able to provide a conduit for expanded data in the future. I think they're doing it with other institutions also. Alex could speak to that.
Thank you all. Ms. O'Connell.
Thank you, Mr. Chair. Thank you all for being here. I want to speak to Mr. Morrison because you spoke about social housing and the housing strategy. Often when we're studying these impacts, those low-income earners are, it's somewhat of a different issue a little bit. One is getting into the market, but the other is just anything that's somewhat affordable and being able to get there. So I want to talk a little bit about some of the things you raised, and this is of particular interest to me because I tried to fight for a lot of these things when I was in municipal government. But there's a lot of barriers, and one of the issues, or you mentioned three in particular that the federal government could do or should do to help. But in listening to all three of those, I saw you still need the provincial and municipal governments. Even if, as you propose, federal assets be used for social housing, Well, that goes against, unless you build only social housing on that, or if you build only social housing on those lands, that actually goes against a lot of provincial and municipal ideas, and one that I hold personally, that you don't build social housing in one area of a community. It needs to be fully integrated. So the second issue is then you have municipal, provincial, if you allocate certain land or certain units to be affordable, how do you ensure, first of all, our definitions of affordable are very different. I know in Ontario, from the municipal side, our definition of affordable is way off kilter. In terms of, and then what do you do if you actually have an affordable unit? Let's say the federal government makes some recommendation, you have an affordable unit, and then that person sells. They're now on the open market. How do you not lose those affordable units? Or what regulation or legislation would you like to see where, even though the federal government can impose to the other tiers of governments in terms of how they must necessarily deal with this, but how would we work with other levels to ensure that it trickles all the way down and keeps those affordable units?
Well, thank you. And before I answer, I just first of all just do want to say on behalf of CHRA that our hearts and prayers go out to the victims of the Quebec situation yesterday. You raise a number of excellent points, and we would agree with what you've said. I think one of the things that we were very heartened to see with respect to the national housing strategy that Mr. Duclos is currently leading is the very strong engagement that he has had with provincial, territorial, and municipal governments. I was fortunate a week and a half ago to present before the Big City Mayors Caucus right after the Prime Minister, where the mayors have made investment in and policy regarding affordable housing a top priority. Their commitment to the Prime Minister was to work very closely to align federal policy along with municipal policy, but we know that provincial governments have said the same. In terms of what federal levers are present, I did mention the three. Those were 3 out of 24 recommendations that we had provided in keeping with the scope of this particular study today. So we wanted to keep the focus on social housing serving as sort of a platform or serving as a springboard for folks who want to move into the affordable, or excuse me, into the ownership space. What we currently have is essentially operating agreements which mandate providers to maintain certain number of units at what we call RGI, within an RGI framework, so a rent geared income framework. With respect to the new policy framework that the National Housing Strategy will build upon, we want to make sure that the maintenance of existing units is protected using whichever mechanisms are introduced, and ideally, of course, to see that market grow, because as we all know, especially from the Toronto area, wait lists for social housing are really have grown quite significantly. So yes, there needs to be essentially a maintenance and protection of what we have, grow what we have using various, and I think what the mayors have said is that they want to work with the federal government to do just that.
Thank you. And just following up on that, one of the areas or one of the ideas suggested that could be somewhat of a finance directive is that in current and existing social housing providers, to ensure that that stock is maintained, if not grown, there are regulations in terms of how much can be borrowed against the asset. And if that because it's a public entity, it's a public ownership of the building essentially, or the units, that if they could borrow against that asset even to a 20% fold or whatnot, that they could actually do a lot without direct cash from, let's say, a federal government or provincial or municipal, and that maybe loosening some of the restrictions around the existing assets in these communities. Do you have a position on that? That's an idea that was presented, but I'm just looking for kind of insight further.
So, Mr. Chair, we agree with 2 of the ideas that you've just mentioned. What we've talked to CMHC directly about is within the operating agreement framework, there are, in some cases, very extreme restrictions on innovative delivery of service, on transformation of operating agreement models, And what we've asked is a number of those restrictions be removed so that providers can experiment, they can innovate, they can shift RGI focus, ensuring that still that the same number of units are RGI. We've also recommended, as a second point, alternative financing mechanisms be put in place as part of the overall strategy. And we understand, although the strategy has not been announced, of course, we understand that that's being given very serious consideration. So setting up essentially a housing bank, a housing infrastructure, or excuse me, a housing financing authority, call it what you will, but that essentially a dedicated program be there to provide that kind of lending capital to providers. We do support.
Thank you. Do I have time?
You've got time for one more.
Thank you. Just further, I asked this question in the earlier round, and I'll open it up to anyone, because in this round you talked a lot about the targeting of this, and my question is really that it's all relative, right? I said this before, that if it's indebtedness, no matter the region you live in, if your debt is risky compared to your income, that indebtedness factor, that test, is going to be relative across the board, versus if you start implementing in one region to the next. In the case of Toronto, what we tend to be feeling in the GTA is that any changes in Vancouver, then the reaction pops up in Toronto, versus a standard stress test of indebtedness. Is that not the type of target that we should be moving towards? It seems more realistic to do something like that. Mr. Livings?
Yes, we agree with the concept of a stress test, and to that end it would be a national stress test because indebtedness is indebtedness. However, we feel that the current stress test is too severe. The impact of it is quite devastating. The level of stress could be refined, and then it would be a very sensible thing to have, but not just for the insured space, which is the first-time buyer. It actually makes sense for the entire mortgage industry, because that would really help to cool some of the overheatedness in some of the markets that we were talking about.
Thank you, Jen. Just while you're on that point, in your submission, you did mention modify the stress test to better reflect future rate expectations. What would be the components of that modified stress test, if I could put it that way? Can you break that down? What do you really mean?
Certainly. What we're saying is that you think about the Bank of Canada's sort of neutral rate currently set at 3%. We recognize that mortgage rates are going to rise above the current level, but if we were to implement something around the level of 100 basis point stress test from current contract rates, which are in the 2.5 to 2.75% range, you're looking at a stress test of 3.5, 3.75%, which would be reasonable in our view. And then as the rates go up, so too would the stress test. And that would be a far better approach on a national basis to dealing with protecting consumers from rising rates in the future.
Okay, thank you. Mr. Alves.
Well, I totally understand what you're saying. At the same time, when you apply something as generic as an interest rate and say, okay, as this goes up, therefore we're going to stress it on every level, what if someone changes their employment? What if someone gets a promotion? We don't account for those kinds of things that allows for that. What if someone lowers their debt? For example, they pay off for their car. So this is a challenge, and I can understand why policymakers can have it, and I do appreciate there being some common sense of saying perhaps a less severe one would be appropriate, because if we base on norms, we probably wouldn't see that. Okay, but getting to what my questions, we've kind of talked about, obviously, the harm this has done to many consumers, particularly for young families that are trying to get into the market. Life has gotten much more difficult because that goal of home ownership has been pushed away. We've also talked about the economic consequences, where we see less economic activity and the government continues to tap down demand rather than supply. I've talked a little bit earlier about the new eligibility requirements, and I noticed that the Credit Union Association particularly has said new eligibility requirements have reduced the pool of mortgages eligible for insurance. This hits the mortgage funding side because these insured mortgages can be securitized. This is a concern for credit unions that have been involved in securitizing mortgages to help fund growth. So you know, I'm worried about the competitiveness of the market because credit unions are not like regular banks where they can issue more shares or issue bonds, et cetera, to be able to capitalize these investments. And also we've heard from monoline lenders as well that they may end up consolidating. So with this policy, may we see some lack of competitiveness, which may end up causing prices to be raised for consumers? And I'll start maybe with the credit union, and maybe we'll just work it out. I'd love some comment on that.
Well, it certainly, you know, as we said, it surprised the market, it surprised us, and to the extent that the system is actually involved in securitization, yes, it puts us on a back foot. You know, we have about probably north of 40 issuers in the country. We have about 283 credit unions overall. So it's predominantly some of the big ones that have had to deal with this, that are involved you know, on the one side you have a bunch of restrictions in terms of what you can portfolio insure now. So when you portfolio insure, that's what you do before you go into securitize. So that's reduced the ability to, or at least the availability of mortgages that can be put through that pipe, but also you just reduce the whole pool of high ratio mortgages too that can be securitized. And what's happening is institutions are competing for those high ratio mortgages because they know they can securitize them. And it's kind of perverse in a way because you're getting competition for the higher ratio mortgages going on when there's more conventional mortgages that are now outside of that pool that might be higher quality in real life, you know. So I'll just leave it at that.
Okay, so this could cause damage, you know, to the competitiveness, though, because again, credit unions and other lenders just may not be able to capitalize and be able to play in that pool. Is that correct?
Right. We, as cooperative institutions, we basically take deposits and fund off deposits and loan off deposits and retained earnings. The mortgage securitization process was another conduit to fund, you know, a small bit of what we're doing, but it still was an important conduit. There are other, you know, banks have other ways of issuing paper, as you said, but also they have the covered bond tool that the government has come up with that currently we don't have the aggregate volumes to use that tool right now. So yes, it's hit us on the funding side as well as on the actual market side.
Okay, and again, what does that mean for consumers? What if someone comes to you and says that we want to get a mortgage? Do you have to turn them away?
Well, I'd say in some markets it's going to be harder for us to compete. So it means that they'll be dealing with the banks probably more. Yeah.
So, Mr. Chair, if you remember back a few months ago, we had the credit unions in here talking about the cost of new regulations that would come into effect this July 1st. I did speak with a very small credit union in one of my areas, and he says that right now, between FinTrack and some of the other requirements federally, they're spending about $100,000 a year just to do paperwork that is associated with the federal government. So we're seeing a lot of touch points on groups like credit unions and whatnot, and I'm quite worried when I read, again, going back to Dominion lending centers, that they feel that further consolidation and lack of choice for consumers is going to be a result. Again, I've nothing against banks, being able, but they just have different tools at their disposal, and that makes me concerned about this policy, Mr. Chair. So, could you elaborate? Does anyone else have anything to say on that particular area?
I would just add that to the point that risk sharing is being considered or studied, that would further exacerbate that situation because you're going to have even more risk sharing put into these small lenders that are going to raise cost for consumers and or reduce choice. A big concern of ours.
Did you want to go?
A little bit more. I'd say our membership, I mentioned in my remarks that we've got 59 banks as members, and it's very diverse from the larger institutions to some of the smaller institutions. For the larger institutions, NHA MBS is a securitized vehicle. It's been getting a little bit more difficult over the last few years to use that model. So the larger banks are less reliant on that model versus our smaller institutions who are probably more reliant on the NHA MBS model. They would need a pool of mortgages to securitize. So some of our smaller institutions will have been hurt as well from these recent changes.
Yeah. Okay.
Sorry, Mr. Martin.
I just have one more thing to follow up on it with the risk sharing. With the risk sharing model, credit unions or small lenders are going to become a counterparty to the insurers, and given that many of, we are basically local, concentrated in particular markets, they're going to start, my guess is what they'll start doing is tying premiums to what they consider their counterparty risk in those regions, which will have to be passed on through higher rates to our members, say in rural, remote Canada.
2 minutes over. Yeah. Mr. Sabera, we'll come back to you at another chance.
Thank you, Mr. Chair, and welcome everyone. I actually start off with Mr. Morrison. I'm actually happy to report that in my riding of Vaughan Woodbridge, which is within York Region, we are actually getting a affordable housing project. There's 2 or 3 happening in York Region. One of them, my riding, for 162 units. The kind of scary thing, though, is that the wait time for affordable housing in York Region is 7 years for seniors and 12 years for families and everything. But I can rest assured our government's working hard to develop an affordable housing strategy with the provinces and with the municipalities, led by Minister Duclos and his thing. I'm going to leave it at that because I got a few other comments to make. Mr. Hogue, your RBC economist, in December, just before Christmas time, you were on TV. You commented on the lack of supply of housing in the GTA and how that was impacting prices. What portion of the price increases that we're seeing is due to lack of supply of housing, which I believe is at historical lows for detached, and for condos isn't that robust either? 30 seconds, please.
Well, it's hard to know exactly what the percentage, because as the previous panel has mentioned, it was so many factors playing a role in it, but certainly on the single detached home side, the fact that now there's about half as many being built as about 10 years ago in GTA, and certainly is a constraint on the supply side.
Thank you. With regards to the credit unions, I grew up in northern British Columbia, North Coast Savings Credit Union, the North Coast Savings Union, Credit Union when I was called, very local institution. We had the big banks there as well, which later I worked at for a number of years, and they were big participants in our community, very local community organization. I've heard a number of comments on the changes that were made in October, and also a number of comments on risk sharing. And I think on risk sharing, credit unions, because they tend to operate in rural, small towns, less served areas versus urban areas, could have the impact, potentially, of rates for those customers in those areas, because, in areas of Canada where economic growth isn't as robust as maybe, say, Toronto, you'll no longer have that cross-subsidization. So you could have the impact on a first-time home buyer in northern Manitoba, and other areas, for say northern Ontario, Quebec, paying 30, 40, 50 basis points more than in other areas. But there's one area that I think we also need to touch on, and this is my question for credit unions, is that when a mortgage is in arrears, there's a large incentive for the insurers to work with the banks to keep the homeowner in the house. With risk sharing, I believe those dynamics change. So over to the credit union, I want you to comment on the competitive landscape and what you'd like to see going forward.
Well, there's a number of things in there. Just wanted to comment on the risk sharing. I think one thing you're going to find is that the risk-based pricing that institutions will pursue will become much more finely granulated. And as you said, we'll be, we may be in Cape Breton, where the market is more illiquid, in places, Gimli, Manitoba, whatever, and people like Genworth and the CMHC will be looking at us and saying, well, they have some housing market risks there because it's a liquid market, might be a downturn in the economy. We're going to have to boost your premiums that you're paying, and we're going to actually force higher costs on you in those regions. So whereas a bank might be able to, a larger national bank may be able to spread some of those risks across because they can move their book of business or change their portfolio up, we don't really have that option. And because we're owned by our members, it's not as if we're going to shut down and move to another part of the country or, you know, sort of start going outside of province necessarily. So I think that's going to be a big issue for us. Did you have anything you wanted to add on that?
I mean, I think given your experience growing up in northern British Columbia, I think you also would appreciate that a credit union really represents the community. And I think any credit union that I've been exposed to does everything they can to try, when someone's going through financial difficulties, to try and make sure that they stay in the house. And certainly the work of the banks and Genworth and others, it's the same idea, right? I mean, you don't want to displace somebody from their home. In terms of the competitiveness, it's clear that the changes in October and, you know, in our earlier testimony, 15 policy shifts since 2006 for very small credit unions is very substantive. So it's clearly had an impact, and you've seen the consolidation within the markets.
And I preface my comments by saying, you know, we need a stable housing market. We need the quality of indebtedness that consumers are taking on to be good quality. But we also need to understand that our underwriting standards within the marketplace are pretty darn good. Like the credit scores of a high ratio mortgage, very constant. The arrears speak for themselves, and I know we can't be backward looking all the time. We need to look forward looking. So one thing, for Genworth, you already pay a 10% deductible. Is that correct? Can you explain that for us, please?
That is correct. There is a form of risk sharing already with the private sector in the sense that while we are government guaranteed, in the event that we are insolvent, in a tail event, the lender will face a 10% haircut in terms of what the government of Canada will pay on a claim. So there is, by de facto, a 10% risk-sharing arrangement with the private sector. And that's something that lenders will bring up from time to time as a counterparty concern, and in fact is a form of driving behavior in terms of how they operate with us.
And, oh, please.
Because of that 10% or the 90% guarantee and the 10% excess risk, banks have to set aside additional capital to protect against that tail risk. So banks do set aside capital in that instance.
Yes, and to the comments about the CMB program, the NHA program, and the covered bond program, they are vehicles in the Canadian market that are very well functioning. They provide a lot of liquidity. Investors pick up those bonds. And the covered bond program, both issued in the U.S. and here in Canada, up to 4% of bank assets, I believe, is the ratio that was been put on. So there are some very fantastic funding vehicles out there, and that provide liquidity and for Canadians to access to get funding to get mortgages. My last question is, any anecdotal data that you can provide from the changes that were put in place to October now? And I think maybe this applies to Genworth the most, but even to any three of you wish to comment.
Certainly, the most obvious change is the reduction in the size of the first-time home buyers' participation rate in the market, which, as we said earlier, could be as much as a third. After considering borrower behavior in terms of buying a cheaper home or further out, it might be 15 to 25%. That has yet to be seen, and that's our point. We need to wait and see what that'll be. But there's other changes too, and that is some of the related changes to the low ratio portfolio rules that were alluded to in terms of eliminating refinance, which certainly does impact a number of our customers more so than others, and does create some disruption to the competitive nature of the market, impacting both consumer choice and cost.
High ratio volumes we estimate would be down near about 35% from the last changes. Of course, we're not into the housing. We're not into springtime house buying, so it's hard to measure. But these are our estimates. That varies across the country. High, of course, in Lower Mainland and in Toronto, and in Alberta between about 13 to 46%, depending on the credit union. Decline in volumes. Low ratio transactional insurance, which is used in a lot of rural areas, down about 50%. Of course, there might be some workarounds, but it's pushing those down. And then also we've seen, we estimate some big declines in portfolio insurance because of refinance rules and all that, even up to 70% at some credit unions. Just the volume's gone. So it's big. It's been very big. And it's a challenge for our system.
Anybody else? Mr. Hogg?
Just in terms of total home resale activity, we've seen a little bit of a slowdown since the fall, but it's still very early on as far as passing judgment on the effect of those changes.
Okay, turning to Mr. McCullum and then Mr. Whalen after that.
Thank you, Chair. Mr. Morrison, I want to talk a bit about provision of social housing. Your association, can you just give us a quick profile of who the members of your association are?
Our members are quite varied. We include social housing providers across the country, municipalities, all 13 provincial and territorial housing departments, nonprofit associations, and interested individuals.
Okay. I had a recent meeting with the Federation of Canadian Municipalities, and they were advocating and trying to see if we would advocate for them that of the $21 billion social infrastructure fund that was set up by this government in the 2016 budget, that they would like to receive $12 billion of it for social housing. Now, would that type of request, if they were to succeed and get $12 billion, what would they do with the money? Would they build units, projects, and own them? Or would they do projects like you were talking about in your introductory remarks, which could lead to the owners eventually owning the unit, like Habitat for Humanity model? You mentioned a couple of other innovative models that I wasn't aware of. I'd like to learn more about. But what type of housing do municipalities build?
Mr. in terms of the FCM requests, what exactly their precise recommendations are a bit different from ours, but I think overall we both support the notion of increasing supply, and whether that would be owned, operated by the municipality through a municipal housing authority, such as, for example, the Toronto Community Housing, or whether that would essentially be a nonprofit provider operating and owning those units. I think there's openness to both. What we do agree upon, though, is that of that $12 billion that they've asked for, and as part of the Social Infrastructure Fund that Minister Morneau announced, I believe, in the fall, was that concept of an infrastructure bank, whereby providers, and by the way, we think that there's some concerns with a bank concept for housing. That's why we've argued for a more distinct housing, specific housing financing authority. But that would be essentially a model that could provide low-cost loans to providers, whether they are municipally owned or on the nonprofit side, regardless, that would provide essentially ongoing capital for those supply needs.
Do you represent any private providers of social housing?
A very small number, and in terms of social housing, the private sector is relatively small, so there may be a small handful, but for the most part, it's the nonprofit.
Okay. There's other organizations that represent cooperatives in housing across this country. How many other associations are there?
Depends on how you define the space. There is an organization, as you suggest, for co-ops. There is, of course, FCM. There is an organization representing the homelessness sector specifically. But within the social housing space, we are essentially the organization.
Okay. Now, I've had examples through the years of being in the industry and leading the industry at one time from a volunteer point of view, that the price per door typically of a social housing project generally runs 30 to 50% more than a private provider. Is that accurate?
Well, I think, as has been pointed out several times by many speakers, the marketplace is different and costs are different depending on the system. I think overall, social housing costs are in line with the private market, with the exception that, of course, The purpose of social housing is to provide rent geared to income units, is to provide subsidized units at below market rates for vulnerable households. So
no one's going to argue that. What I'm saying is when private provision could provide it for, let's say, $80 a square foot per door, and social housing is anywhere from $120 to $150 a door, this is kind of the analysis that I've seen in different markets in different occasions. When the government's paying, it costs more. I think that's the general thinking in the industry. So what I'm suggesting to you is this was actually recognized in Great Britain. And Great Britain had a reflection of what's the best way for the people who need social housing to make sure they have access to the product they need, just like we're doing through a $12 billion, let's say, investment by municipalities. And they decided that it's better to give the money to the tenant, to the owner, the potential owner and tenant, and let them seek out in the market the kind of housing. What's your views on that?
So as you probably know, part of the discussions regarding the National Housing Strategy is the concept of a portable housing benefit, which I think gets at the concept that you're raising. We have some concerns with the concept. First of all, there is definitely the potential for inflationary pressures, especially in the rental sector. If landlords know that people are essentially getting this personal benefit, there is that potential for increasing rents. We're concerned with the accountability surrounding the potential concept. So how would essentially government, or how would it be assured that the individual is in fact using that portable benefit for the purpose in which it is intended? And frankly, it's the administrative concern, is just how exactly would a federal individual portable benefit work? One of the benefits that we've talked about in terms of providing such a portable benefit but tied to the unit is that many of those concerns are allayed. The administrative functions is already in place. There's guarantee in terms of the accountability for what it will be used for, and really, given the nature of the agreements with the federal government, inflationary pressures can be essentially maintained or contained.
I think I have just little time left. Would you agree that home ownership means everything to a person? If they can get into a home and own a home, that just says so much for them as a person in their terms of their life, their esteem, all of those things. Habitat for Humanity does that. I would like your insights shared with government on how you get a model of social housing that does that. I've never seen anything like it, that when the keys are handed over to someone in a Habitat for Humanity home.
I don't think there would be any question by anyone in this room that having a house or having a roof over one's head is a precondition for just about everything else that you want out of life, whether it's health, whether it's education, whether it's family, and so forth. So I don't think there would be any disagreement there. The reality is, for many Canadians, though, that path to home ownership is not as clear-cut, is not as available as it is for others. And so when we talk about housing policy, we really need to be thinking in that holistic perspective of, yes, the private market, but for those Canadians that really for whom that path is not there, we need to look at the tools and the supports needed so that, yes, eventually, I think we can agree that having one's own home would be a desired aspect, but can we put in place the policies to provide that bridge to allow people to traverse that path?
Thank you.
Mr. Whalen.
Thank you very much, Mr. Chair, and thank you all for coming. I just sort of maybe like to step back for a second and maybe challenge some of the axioms that underlie what we're looking at here. The first I'd like to challenge is whether or not home ownership is the end-all, be-all. Canada has, what we heard earlier today, the highest home ownership rate in the developed world, and I'm wondering whether or not we have a lack of rental units outside the social housing space for families, and that if someone even wanted to rent in the space for family, whether or not they could even find something appropriate in the markets we're talking about outside the social housing space. And I'm not sure if anyone has looked at that on the panel, and whether or not we have a lack of affordable rental family homes or affordable homes of the particular quality and style that first-time buyers or second-time buyers, more importantly, are looking at. Anyone?
Again, it depends where you're talking about. In terms of the rental stock, if you talk about Montreal, Quebec City, there is a lot more there. It's very scarce in Vancouver. So there is a whole spectrum, as much on the rental side as of different circumstances as it is on the ownership side.
Mr. Morrison?
Yeah. I mean, what was interesting, I believe it was in November 2016, CMHC released their rental market report, which actually revealed that supply of rental has been quite robust. And that rental rates themselves have somewhat stabilized. Now, again, absolutely correct that this differs region by region, but at a macro national level, that in fact the rental supply has been fairly good. But I think to your point about is home ownership sort of the end all and be all, when you look at a country like Germany, in which the rental rates are at approximately, I believe, 50 to 60%, and that home ownership is not the be-all and end-all, I think it makes the point that, and this is why I tried to choose my words very carefully, that at the end of the day, it's the roof over one's head that most Canadians, find most attractive or prioritize. It's not necessarily the case that ownership has to be the final solution, and for many of our tenants in the social space, it's just simply not something they can realize.
Availability is important. Mr. Lemmings, you had a comment?
Yeah, I'll just say that from our perspective, condo construction has really served the need for the rental market because there hasn't been any purpose-built rentals for many years. But the vast number of condos that get constructed in both Toronto and Vancouver, while they caused some concern at one point, we've seen it be absorbed by investors for renters, and it has provided the rental accommodation. On the point of home ownership, what I would say is this: we really firmly believe that home ownership is truly that cornerstone of the well-being of a family, and that when we speak to our consumers, our first-time buyers or immigrants, having that ownership is a very big, important step. It's also that ability to build equity through the forced savings of a mortgage payment that also protects you from rental rate increases. When you own a home, you're not subject to potential rate increases of exorbitant amounts.
Thank you. I want to move on to my next question. Sorry, Mr. Martin. The other axiom I wanted to challenge was whether or not the debt-to-income ratio that people talk about as causing great concern is the thing that we should really be worried about. If we look at that number at the different segments of the market, is it really a concern for first-time home owners? Is it really a concern for two-income families with kids? Or are we focusing on the wrong thing when we're talking about debt-to-income ratio? Again, Mr. Capillard, I know you have thoughts on Mr. Lemmings.
I would just say the debt-to-income ratio is just one ratio amongst many that are available to analyze the housing market. So, for instance, you've got the debt-to-income ratio, and then you could look at that and also look at, say, the net worth to income ratio and the debt to asset ratio, which looks at not just the income of one's individuals, but also looks at the asset side. So while debt to income ratios are quite high, the assets that are backing up the debt, because they are largely used to purchase assets like homes, are also increasing in value. So Canadians are the net worth of Canadians is actually quite high. The other thing to note too is debt servicing ratios have actually been coming down as a result of lower interest rates. My point in all this is just you can't glom onto just one ratio. You have to look at the whole series of ratios.
Mr. Lemmings, did you have something to add?
That point that Alex made, that debt ratios are only one measure. When we underwrite a borrower, we always look at the full spectrum, the credit profile, the income stability and sustainability, the level of income from one or two borrowers, and of course the asset that it's backing as well.
Okay, so when you said earlier that the lending risk really isn't at the first-time home owner, where is the debt risk in the Canadian market right now, in your opinion?
We have a view that a true stacked risk would be someone with obviously the smallest down payment, but in addition, low credit scores, very high debt ratios, and also buying with a single income, in the sense that they're the most vulnerable to a risk in their employment. And we certainly know that in our own portfolio, Today, in order to afford a home, we see a dominance of double-income families. 2/3 of our borrowers, in fact, present with 2 incomes. That's pretty much almost the only way you can buy in many parts of the country.
Okay, just before I turn to you, Guy, in December, this committee tabled a report that was in advance of the 2017 budget, and looking at what ways do we enhance economic growth. From your perspective, does the measures that were implemented in terms of the housing crisis really in Vancouver and Toronto, housing inflationary prices in housing, does that dampen the possibility for economic growth? And if it does, then what would you suggest be done in order to kind of neutralize that impact? And secondly, also ensure that you have stability in the financial markets. Anybody got any thoughts? Mr. Hogue?
I mean, you've heard in a previous panel some estimates of the impact, the economic impact on the part of the Bank of Canada of the recent measures, and like a third of 1% over a number of years. So at the margin, yes, these might lead to some reduced rate of growth in the country. But that being said, these are very difficult, as they pointed out. I mean, we have very few historical precedents or any kind of tools to really assess the economic impact of those measures. So, as they pointed out, I mean, there is quite a bit of uncertainty with respect to the economic impact at the end of the day.
I think if there was one thing we certainly learned when we had the regional development agencies as witnesses in our previous study, this is a country economic regions. And as a number of witnesses have mentioned today, this is also a country of entirely different housing markets when you're looking at Vancouver, Toronto, remote areas, Prince Edward Island, you name it. And the one policy fits all can create certain complications in certain areas, especially in rural areas. Anyway, anybody else got anything they want to add to that previous question I raised? Okay, with that, we'll turn to Mr. Caron.
Merci beaucoup.
Thank you very much. I'd like to come back to where I was at during the previous round. We talked about the reliability and quality of data, and we mentioned that the more data was made available by Canada Mortgage and Housing, the better it was. You are independent, Genworth, so the access to your data is perhaps more limited. I think I put the question to Mr. Morrison because he asked the question, should we give this mandate to Statistics Canada? Do you think that StatsCan might open up another division, somewhat like with the labor force survey that we have for the job market? We could have some kind of a division that would study this type of thing for the real estate market, or would there be other entities that might be better suited for this? Forgive me, I will answer in English.
A federal government department in playing this enhanced role is that it may not have the mechanisms to bring together the wide array of stakeholders that would be necessary and that would be beneficial to do so in that kind of a forum. So if you were, for example, to have a StatsCan-run body, that may not allow for the active participation of the provinces, of municipalities, of territories, of other research hubs and organizations that currently exist. In addition, I think one of the hopes that we will see out of the National Housing Strategy is that as a means of measuring the impact that the strategy has, is that the federal, provincial, territorial, and possibly municipal governments will establish a series of indicators and measures such that we will know year over year whether the goals and objectives in the strategy are actually being met. To do that, there would need to be some form of an intergovernmental component to that research body, and whether a federal standalone department or organization such as a StatsCan, for example, could do that is questionable. So we would see, and again, we look at some different models, both international and even domestic, that could serve that purpose.
Est-ce que tout le monde est de cet avis-là aussi, partage l'avis de monsieur?
Does everyone share Mr. Morrison's opinion? StatsCan would be able to offer this service. Clearly, it goes beyond, extends beyond the federal area, but StatsCan can cross all levels of government, has the expertise, so it's a matter of will rather than anything else.
Regulated financial institutions, we provide a tremendous amount of data already to the Bank of Canada and OSFI, so it's not necessarily public, although some of it is. But that the federal authorities do have a pretty good lens as to what's going on in the federally regulated financial institutions. And I also know CMHC, we're working with CMHC with respect to helping them to fill some data gaps. They themselves have issued some publications. Their securitized book, that they've published that, as well as mortgage insurance mortgage insurance business supplement that has been issued as well. So I think the stakes have been moved a little bit more over the last year or so in terms of addressing data gaps, and I suspect there will be still more to come.
Merci beaucoup. Oui, monsieur.
Thank you very much. Yes, Mr. Martin?
As Alex has mentioned, that CMHC is going in the right direction right now. They're providing more data publicly. They're engaging with more stakeholders. We're being pulled into a lot of the discussions. We're grateful for that. And it would be unfortunate if somehow that got waylaid because there was a shift in where it was going to reside in government. So I think I prefer it to remain where it is.
Je vais revenir à vous, Monsieur Morrison, dans votre présentation.
I'll come back to you, Mr. Morrison. In your presentation, you mentioned that it would be beneficial to draw lessons from best practices internationally. Now, most commentators and the witnesses we heard before you were saying the same thing. Well, we agree that we have one of the best systems in the world. But what types of best practices might we adopt that would improve the best system in the world that we already have?
It's an interesting question in that one of the models that I talked about in my opening remarks, whereby I referred to a model of social housing that actually incorporates financial literacy programs in which the provider actually provides an upfront grant that is matched by the tenants as part of this one particular program. That fund is put in escrow, and then the tenant is able to use that fund for whatever they would like, including a down payment. That's actually an American model called Compass out of Boston. So we don't have a comparable similar model in Canada. We hope that we will. And again, we want to see greater innovation and greater transformation, greater creativity within the social housing space in this country. But because social housing is by its nature a different model than the private sector, because it is also heavily reliant on supports. Social housing is more than a roof over your head. It is also provision of social, health, legal, financial supports. And because there's different ways to kind of carve that pie, we do think there's great value in learning from what our international counterparts are doing and bringing best practices to Canada. So as part of a research hub, that international component we think is absolutely crucial.
Is that it, Guy?
Ouais, ça va être tout.
Okay, you got more questions? Dan, okay, a couple of last questions and then we're going to wrap it up. Go ahead.
Thank you, Mr. Chair. Just again, in regards to many, I'm sure, were here for the previous panel. And one of the observations that the Office of the Superintendent of Financial Institutions said when it came to pricing risk, that was a non-regulatory call. That's the choice of every institution, whether it be a bank or credit union or mortgage lender, et cetera, to make. But from my listening into everyone's testimony, that may be true, but I don't think that any of us here would believe that there wouldn't be a risk premium included into because of the new regime. Am I correct? Would anyone like just to? I see some head nods, but that won't be in the testimony. Yeah, please, and we'll just work our way down.
So from my perspective, I think, what I would say, and we're not a lender, obviously, we're the mortgage insurer. Our premiums are driven by the losses we would expect and the capital we have to hold. But we have observed pricing changes in the industry related specifically to some of the changes, in particular on the refinance side. So rates have gone up because funding is now harder to get, and therefore there is a higher cost, and that is being passed on to the consumer as an observation.
Yes, and that's precisely our experience. That's what we're seeing in the market.
We've seen some lenders increase rates for a particular set of mortgages, say mortgages with longer than 25-year AMs. We have seen some lenders do that as well.
Okay, so while the government is completely, I think we all agree, government should create a market that then private enterprise can work within and whatnot. But in this case, by changing the rules of the game, so to speak, that does change behaviors, including costs, which ultimately are borne by the consumers, or through competition. Like we were saying earlier, consolidation by certain parts of the lending industry or through credit unions. I guess you can't, like you said, take your members' move. The other brief question I was going to have, Mr. Chair. Yeah.
I'll let Mr. Whalen in and come back to you. Sure. Mr. Whalen.
Thanks, Mr. Chair. We've talked a lot about demand-side regulation and demand-side forcing in the market in order to reduce risk. What about supply side? Are there things that the federal government can consider on the supply side to increase supply to help bring down prices? Are there things that the federal government used to do or could be doing now to allow the supply in the market to grow to help depress prices? Or is that a zero-sum game?
I would say that is an absolute driver of the problem, and it's a very complicated one, because supply is often caught up in local government or local municipal issues, and availability of land, availability of developers. It's a very complicated issue, but one that should not be ignored, and that goes back to one of our recommendations, which is to collaborate with local governments and municipalities to study all these areas, because there are potentially ideas that could come there that would help supply.
Right. Sorry. I would also add, too, that I think there's an acknowledgement by the federal government with respect to the fact that they don't have all the levers when it comes to addressing sort of supply side issues. Back in June 2016, they announced there was a federal, provincial, municipal working group on housing that acknowledged this fact that housing prices are driven by a variety of factors, both supply and demand side, and federal government has just a certain amount of levers, and there needs to be increased coordination amongst the three levels of government.
Just very quickly, in our world, supply is the key priority. And a number of the recommendations that we've submitted regarding the National Housing Strategy, including the notion of the creation of a dedicated housing infrastructure, a dedicated housing financing authority, are meant to address exactly that.
Mr. Albus, last question.
Because I did want to touch on the social housing side. I'll give you a good example. On Vancouver Island, the health authority actually contracted with a private contractor who ended up building to spec an apartment building specifically for people with disabilities. So, and at a very good rate. Now, the challenge was when this gentleman went to Canadian Mortgage and Housing Corporation, and he was told that he would not receive the same lowered insurance rate for the mortgage that if the health authority had constructed the apartment block, that they would have received. And when asked upon the policy, it basically, there's no law that says they can't. So I really hope, because of what my colleague here, Phil McColman, has said earlier about the savings that could be used if you leverage the private sector's expertise and efficiency in order, and into such a way where the public sphere can help people who need it the most, would be able to benefit because we could build more housing and we would have less risk overall. So I really would hope that when you're talking to the minister, or if any of the minister's staff is listening, that you would take that kind of feedback into consideration.
A quick answer.
And very quickly, to be clear, we are not discounting the private sector. There are some really innovative triple Ps happening. We spent the day with the head of the Edmonton Housing Authority the other day, where actually private sector partners are lining up around the corner to wanting to partner with that housing authority. So it's not off the table. But certainly the provision of housing from a public standpoint needs to ensure that rents are maintained at that subsidized level. Thank you.
Saying that the private
okay,
sector
we are at the adjournment hour. Mr. McDonnell, I don't think you had the chance to say anything. Do you want to say anything to wrap up so you'll be on the record?
No, thank you very much. My colleague Stuart Levings has said enough.
Okay. I don't know if that's good, Stuart. Anyway, thank all the witnesses for coming. Meeting adjourned.